deferred consideration, the share exchange consideration, and something called the contingent consideration. In our previous session, that is on Tuesday, we looked on how to prepare the group accounts, how to prepare the consolidated financial statement, specifically whereby the parent company has invested in a subsidiary. So we started by looking on how to prepare the consolidated statement of financial position, which we said is basically prepared by combining, by adding together similar items of assets and liabilities, those of the parent and those of the subsidiary. And after doing that, we said there are those consolidation adjustments which are made. I think we talked about how many consolidation adjustments, a number of consolidation adjustments. I think we talked about 4 of them. Adjustment for unrealized profit, adjustment for the fair value adjustments, adjustment for the amount of intercompany debt, which is the same and which is not the same. And also we talked about adjustment for the goods in transit. Then from there, we looked on how to prepare the consolidated statement of a profit or loss, which essentially we said is prepared by combining, adding together similar items of revenue and expenses, both of the parent and those of the subsidiary. But we say that in case a subsidiary was acquired during the year of consolidation, some few months to the end of the year, we said we only take into account its revenue and expenses from the date of acquisition. So if it was acquired 6 months or maybe 9 months to the end of the year, we only take the revenue and expenses of the subsidiary basically from the date of acquisition to the date of consolidation. We apportion the revenue and expenses of the subsidiary on time basis. Then from there, we were also able to look on the various consolidation adjustments which we make in preparing the consolidated statement of profit or loss. Now, that is basically what we know as per now. And I think what I requested is that before we meet today, is that you need to go through all those particular concepts which we discussed, such that as we meet today, you can be able to remember all of them, because you'll be able to see that the question which you're going to do, you'll be able to see that all those particular concepts are being tested. Starting with the computation of goodwill, adjustment for amount of intercompany debt, adjustment for unrealized profit, adjustment for the fair value adjustment, intra-group trading, and so on. So basically, that's what we had agreed. Okay, so I want us to go to the question, and basically we're going to look on the question which was examined last sitting. That is the sitting of August. The sitting of August 2025. August 2025. Let's go to our past papers. Let's go to our past papers. Let's go to the past papers. Let's go to the past papers. In the past papers, we have the question for last sitting. The question for last sitting. And basically this one is question number 2. Let's go to question. So the name of this company is what? Is the Budo Limited. And basically this is what? This is the statement of cash flows. This is the statement of cash flows, which is basically for the year. Which ended 31st of October 2023. So having that title, then we need to proceed, and we have now the 3 subheadings. So we always start by determining the cash flows from operating activities. From operating what? Activities. So here we need to have 2 columns, and I hope you can also be able to see that our values there are given in thousands of shillings. Are given in thousands of what? Of shillings. That should be the first subheading. So here we said we have a number of items which are recorded here. Make sure you leave enough space, like maybe half of the page. Half of the page should be enough. Then from there, we proceed and basically we determine the cash flow from investing activities. Remember, for investing activities here, we consider the asset, or actually what we consider here are the assets which were acquired and basically the assets which were sold, plus any income generated from investment. And then next year, we basically determine the cash flow from financing activities. So, and actually we say that all the items which we include here, we basically get them from equity. We get them from equity and the non-current liability section of the statement of financial position of the statement of financial position. Having that, then down here, we come and we record the cash and the cash equivalent, the cash and cash equivalent balance brought down, and then finally the cash and cash equivalent balance carried down. So when talk about the cash and cash equivalent brought down, this is basically the cash and cash equivalent at the start. Whereas now this is the cash and cash equivalent at the end of what? Of the year. So basically this is like a skeleton of what we want to prepare. So then a skeleton, basically we need to add some meat here for this now to be complete. So now, whenever you're doing this particular question, usually I advise the student, first of all, to record these two items here. The cash and cash equivalent at the start and at the end. Remember, we said in most of the questions you'll come across for cash flow, always will be given this. The cash and cash equivalent at the start and also at the end, which is basically given as part of the current asset. So if that is not given, then we said to compute the cash and cash equivalent at the start and also at the end, we add basically a number of items: cash in hand, cash at bank, short-term investment. Short-term investment is an investment which are given as part of the current asset, and then we also less bank overdraft. If we have a bank overdraft, that bank overdraft should be deducted here. So therefore, what we need to do, can we go to where we have the current assets and we see whether we are given the cash and cash equivalent at the start and also at the end? So are you there? So at the current assets in our statement of financial position, do we have cash and cash equivalents? Do we have cash and cash equivalents? Yes or no? Yes. So I can see we have cash and cash equivalents. Now, even before we transfer that here, we said it's also advisable you go to where we have current liabilities and you check whether there is any bank overdraft. Do we have bank overdraft at the current liabilities down there? Do we have a bank overdraft? Automatically no. Automatically no. So therefore, we already have the cash and cash equivalent at the start and also at the end. Those are basically two free entries here. So the cash and cash equivalent, remember also here we should have two columns. So the cash and cash equivalent at the start. And remember here we are given 2 years, 2023, basically 2022. So these are opening balances. The values we have here are opening balances. Whatever you have here are closing balances. So the cash and cash equivalent at the start of the year in 2022 is basically 4670. And then the cash and cash equivalent at the end is 6360. So those are basically just some free entries. So then from there, because you're using the direct method, indirect, not direct. So we need to come back here. And here we said always we start with what? We start with the profit. We start with the profit before what? We start with the profit before tax. So this is something we get from the income statement. Can we go back to the income statement which are given there? And we take the profit before tax. So the profit before tax basically is how much? Is 18,700. Is 18 what? 700. I hope you can see that. And then now to this profit, we said we make a number of adjustments. In other terms, we adjust this profit with a number of items. So the first adjustment which we make to this profit is basically to add back the finance cost. to add back the finance cost. The finance cost, we said, is always given above this. Is always given above this profit. And I hope you can be able to see the finance cost. Can you be able to see the finance cost just above that profit? Yes. It is basically an amount of 38. 38 like that. Sasa, yes. And then after doing that, we basically make a number of adjustments or other adjustment to this profit, and we make adjustment for non-cash items. For non-cash items, we say just record this acronym, dial G, dial G, dial G. So this one basically stands for what? This one stands for depreciation on property, plant, and equipment. This one stands for impairment loss. So we said maybe at this point, you may not come across a question with impairment loss, but once you move to the upper level, definitely you'll come across this. You'll come across impairment loss. So then this one stands for amortization of intangible assets. Amortization of intangible assets. This stands for loss on disposal. The loss on disposal, whereas this one stands for gain on what? On disposal. The gain on what? On disposal. And basically, we said these first four items should be added to this profit, whereas the last item here, that is the gain, should be deducted. I was able to explain the reason behind that, why the first four items should be deducted, should be added back, actually not deducted, and the gain should be deducted. Remember, you said these items, in arriving at this profit, they were accounted for as expenses. In arriving at this particular profit, they were deducted. And because they are non-cash item, we add them back. In arriving at this profit, the gain on disposal was added. It's a non-cash item. So what do? We less it. Now, I think on the face of the income statement, no any other adjustment which you can make to this profit here. But now, can we go to the additional information? We see what you're told. And basically what I said, and that is also something I mentioned in the topic of group account, that if you feel maybe a certain working is a little bit complex, just ignore that. It's not a must you have to get everything correct here. Sasa, yes, it's not a must. So in the additional information, we are told that the property, plant, and equipment was made up as follows. We are given the costs that was supposed to be cost or valuation, not cost or valuation, cost or valuation. At the start and also at the end. We have the accumulated depreciation at the start and also at the end, carrying amount which are the same with the net book value at the start and also at the end. Is there anything we can be able to bring here in relation to that information? No. So then you are told in the other paragraph, during the year which ended 31st of October 2023, a property was revalued upward by a gain amounting to 1.2 million. So do we recognize that gain here? No, we said anytime the company revalue asset and we have a revaluation gain or loss, we don't recognize that within our cash flow. This is a non-cash item. And then you're told the company does not make any transfer for excess depreciation upon revaluation. And then you're told, however, it accounts for deferred tax on the revaluation gain. So the income tax applicable to Budo Limited is 30%. So I'll be able to explain how we are going to account for that deferred tax on the revaluation gain. So that one, actually, we are going to account for it when preparing the deferred or actually the tax account. I'll be able to explain how. So then you're told in the other sentence, depreciation on property, plant, and equipment has been charged to the profit and loss. Are we given that depreciation? No. So we have to compute that. We can ignore that first of all. Let's go to point number 2. In point number 2, we are told during the year which ended 31st of October 2023, Budo Limited had acquired some patent rights at a cost of 5 million. Remember, patent rights is an intangible asset. So this company acquired a patent rights at a cost of 5 million. This is an asset, intangible asset, which was acquired. So whenever the company acquires an intangible asset, that is an investing activity. So we consider that here. Acquisition of what? Of patent rights. And basically in this case, I've said that patent rights is this what? Intangible. This is a form of an intangible asset. So the patent rights which was acquired basically had a cost of 5 million. This, remember, is a cash outflow. We said that is very, very important. If, for example, that figure, you record it here as a positive, that is wrong because this is a cash outflow. Is a cash what? Outflow. So and then you're told in the same point number 3, any amortization of intangible asset has been included within what? Within administrative expenses. I think we can compute that, because I hope you can remember the two questions which we did. We were able to compute the amortization. Either amortization was given, but the value of the intangible asset acquired was not given. So we say to compute amortization or the value for intangible asset acquired, you just prepare the intangible asset account. Now, can we go back to our balance sheet where we have the non-current asset in our statement of financial position where we have the non-current assets? Under the non-current asset, we have property, plant, and equipment and intangible assets. So the account we need to prepare is the intangible assets account. How do we prepare this account? This account we said we debited with the value for the intangible asset at the start. The value for intangible asset at the end of the year should be recorded down here. Then on this side, we record something called the amortization. And then on this side, we record what? Acquisitions. Well, there's some intangible asset which were acquired. What we are given in note number 2, we are given intangible asset which were acquired, which are the cost of 5. So then can we record the opening and the closing balance? This is now what we have in the statement of financial position, under the non-current asset. So the intangible asset at the start of the year, which is 2022, is basically 23,680. And then at the end of the year is what? Is 24,290. So what we need to do is we get the balancing figure on the credit side, which automatically represent what? Amortization. Remember that amortization, we basically recognize it here. So how much will be the amortization? We add what we have on the credit, on the debit side. So which will be 28,680. 28,680 minus 24,290. So that will be 073. 43 what? 43 90. 4390, yes. 4390. So 4390 is the amortization. Remember that amortization should be added. Should be what? Should be added. So we already have that amortization. Yes. So, and think we are done with that point number 2. Let's move to point number 3. We move to point number 3. In point number 3, what are we told? We are told that the company repaid some borrowing which had matured during the year and issued new notes amounting to 3 million. So these are basically some borrowing which were repaid. So repayment of borrowing, that is basically a financing activity. That's why, for example, if we go to where we have non-current liabilities, can you go back to a statement of financial position? Below equity, or basically below assets, non-current, current, we have equity, and then below that we have long-term borrowing. So long-term borrowing, you can see, is part of the non-current liability. That's why I'm saying repayment of borrowing is a financing activity. So we consider that here, repayment. A repayment of what? Of borrowings. So how much amount was repaid? The amount which was repaid as per note number 3 is basically how much? 3 million. So repayment of a debt. Repayment of a debt, is this an inflow or outflow? Once you have borrowed money, you have repaid that money. Inflow or outflow? Repayment of money borrowed. If you repay money you had borrowed, what is that? Inflow or outflow? Inflow or outflow? Abdul Nasir. Yes, this one is outflow. So being an outflow, we record it here as a negative. We record it here as what? As a negative. Now, still, under the non-current liabilities, in our statement of financial position, this particular long-term borrowing, you can see it's basically reduced with from 46,800 to around 37. So is that decrease of 30,000? Is that decrease equal to 3,000? Because that decrease should be equal to 3,000. Oh, sorry. We are mixing. Let's go back to note number. Wait. Let's go back to note 3. I think we are told the company repaid some borrowing which had matured during the year and then issued new loan notes amounting to 3 million. Sorry for that. So this is not the repayment, but this is not repayment, but basically we are given loan notes, or basically are they loan notes or what? They are referred to as what? They are referred to as the notes, the loans, the loans. These are basically the same with what refers as the loan notes. We have loan notes which were issued, which were issued, which basically amounted to 3 million. So these are like debentures or loan notes or debentures. That is debentures, loan notes, or both, which were issued. If a company issue loan notes or issue debentures, the company receive money. So basically, what you are not given in that note are the repayment. How much amount was repaid? Basically, for us to be able to determine the borrowing which was repaid, we basically prepare that account which is called the long-term what? Borrowing. The long-term what? Borrowing account. Remember, this is a liability account. Being a liability account, the opening balance in this account will be a credit balance, the opening balance. The closing balance will be here. And then number 2, if a company happened to have issued some loan notes or basically some debentures, that increases the amount of long-term borrowing at the start. So any issue of a debt instrument, that one should be credited here and then debited in the bank. And then what we have on this side is a repayment, because repayment basically reduces the amount of borrowing at the start. The amount of borrowing at the start. So what you're given in note number 3 are these loan notes which were issued, basically 3,000. So we then record the opening and the closing balance. We determine this. So, and we get that from our statement of financial position and the non-current liabilities. And the non-current liabilities, the long-term borrowing at the start, which is basically the year 2022, is 46,800. 46,800. At the end of the year is what? At the end of the year is 37,550. 37,550. 37,550. Yes, we get the balancing figure there, which is basically repayment. So these are the long-term borrowings which were repaid. So I'm told that will give us 12 to 50. 12 to what? 250. 12, 250. 12 to 50. And basically the payment, remember, that is a cash outflow. That is a cash what? Outflow. So I think those are basically the entries which we can be able to post here from the information which we have in the additional information. So basically it means that like in this question here, you can see there is no asset which was disposed, because we said if an asset is disposed, you must be given that information. You must be told it was sold at how much, so that you can be able to determine the gain or the loss on disposal. Automatically, there was no disposal. So we will not have any loss or gain on a disposal. Also here, we will not have any impairment loss because we don't have goodwill. But basically, this is something we have to compute. Maybe I'll see whether we can compute this one. If you feel the working is a little bit complex, you may decide to ignore that. Then from there, we said we proceed. Even before you do any complex working, we said, first of all, can you correct the free marks? Can you correct the low-hanging fruits? So we consider the changes in working capital. We consider the changes in working what? Capital. And we said, if you happen to come across a question for cash flow, these marks to December, these marks are free. These are marks here are free. 3 entries here for working capital: receivables, inventory, and payables. We said, make sure you get this. Make sure you get these marks here. Changes in working capital. Now, here we said we just consider 3 items. We just need to remember this acronym, RIP. RIP. We consider the receivables, the inventory, the what? The payables. And then other than remembering that, make sure you remember this formula, we take opening minus closing balance, opening minus closing balance, but for payable, we take the closing minus opening balance, closing minus opening what? Balance. Sasa, yes, it becomes quite simple here. So by applying this particular formula, whatever you get, you record it here. If it is a positive, you record it here as a positive. If it is a negative, record it here as what? Is a negative. We will start with the receivables. What do we have under the current asset? Under the current asset, the first item there, we have the receivable. So we apply our formula here, opening minus closing. So the opening is 5760 minus closing, which is 5880. That will give us negative something. That will give us negative something. Negative what? Negative 120. Negative 120. Negative 120. Is that what you're getting? Negative 120. Negative 120. Inventory 5760 minus 5880. Or 220. 220. 220. 220, and that is a negative. Yes. So then below inventory, we have payables. Sorry, we have receivables. That is, we take the opening balance, which is 4290 minus closing balance, which is 4070. So that will give us positive. That will give us positive. Is it positive 220? And I need to get the confirmation of these values. I'm not getting any answer in the chat box. Can you confirm whether those values are correct? Is that what you're getting? Inventory is negative 120. Receivables is positive 220. Positive 220. Okay, yes. So that is okay. Then from there, we move to where we have the current liabilities. Current liabilities, we consider payables. We apply this formula, closing minus opening. Closing, which is 78 minus 82. Minus 82. That is basically negative 400. Negative 400. So easy marks, make sure you get those marks. If you happen to come across a question on cash flow, those are purely free marks. Sasa, yes. So then from there, we move and basically we determine two items. Tax paid, and then the interest expense, which was paid. I think we can start with this one, interest. Remember, I said for interest, we consider two items. One, we consider the finance cost from the income statement, this one. And then from there, we go to where we have the current liabilities. We check whether we have any accrued interest or any interest payable. Do we have any accrued interest or any interest payable? Yes, I can see we have accrued interest. So in case we have an accrued interest, how do we compute the interest which was actually paid? So I think I explain how we compute this one. We take the accrued interest, or in other terms, the interest payable at the start. Remember, this is what our company was supposed to pay, because interest payable is what the company was supposed to pay. You take that plus what the company was supposed to pay from the income statement, this one. That is 38. 38. So that will give us the total interest which was supposed to be paid during the current year, minus what the company had not paid at the end. That is the interest payable at the end, which is basically 35. So the difference here is the amount of interest which was paid. The amount of interest which was paid. So the amount of interest which was paid here was how much? Was 50. 51. So that is basically the amount of interest which was paid. And then we said for this tax, this one we have to prepare a tax account, because we said the number of items which we record here, tax, What do we record on this side? We start by recording the deferred tax at the start, the current tax at the start, and then the tax from the income statement, the tax from the income statement. And then on this side down here, we record the deferred tax at the end, the current tax at the end. The balancing figure here is the tax which was paid. So can we go to where we have the non-current liabilities in our statement of financial position? That's where we have the deferred tax. And the non-current liabilities in the statement of financial position. So the deferred tax at the start was 70/70. The deferred tax at the, that is at the start, at the end is 67.50. Then below the where we have the current liabilities, below where we where we have the current liabilities, we have the current tax. The current tax at the start was 55.70. The current tax at the end of the year was 42.30. So then 42.30. Then we go to the income statement. We take the income tax expense for the current year. So the income tax expense for the current year from the income statement is basically 48.30. 48 what? 30. So we balance our accounts. The balancing figure here is the amount of tax which was paid. The amount of tax which was paid. The amount of tax which was paid. Which was paid. How much tax was paid? Sorry. There is something we are almost forgetting. There is almost something we are almost forgetting. Note number 1. Can we go to note number 1? Yes, there is something else which we will introduce here in relation to note number 1. Let's go back to note number 1. And in note number 1, we are told in the last paragraph, we are told during the year which ended 31st of October 2023, the property was revalued for a gain of 1.2. There was a revaluation gain of 1.2. And we are told the company does not make any inter-reserve any transfer for excess depreciation upon revaluation. However, it accounts for deferred tax on revaluation gain, and the income tax applicable to this company is what? 30%. This is something we discussed in the topic of deferred tax. And I think I said anytime the company has revalued an item of PPE, and basically that gives rise to a revaluation gain. Like in our case, there is a revaluation gain of 1.2. So basically, we have to compute something called the deferred tax on revaluation gain. Sasa, deferred tax on revaluation gain. How do we compute this deferred tax on revaluation gain? We take the revaluation gain, which is this one, times the tax rate. Times what? The tax rate. And basically that would give us an amount of 360. So how do we account for this particular amount of deferred tax on revaluation gain? We say that this one should be debited in the revaluation reserve account. In the revaluation reserve account, and then credited in the deferred tax account. So this, take into account, we are recording the deferred tax here, the opening balance and the closing balance. This account here, we are recording deferred tax, and also we are recording what? The current tax. So therefore, this amount will be credited in this account. And I hope you're getting 360 there. 30% of 1,200, I hope that one is 360. Is 360. I hope that one is 360. So that one should be credited here. This is the deferred tax on revaluation gain. The deferred tax on revaluation gain. So then we get this. But I've said equally, if you feel that working is too complex, it's not a must you do it. It's not a must you do it. So how much will be the tax which was paid? The tax paid, the balancing figure in this account on the debit side. The balancing figure, I'm told by Otito is 68.50. 68.50. 68 what? 50. 68.50. Yes. So I think we are basically done with that. We are basically done with that. Then from there, I think what then we need to do here is we need to check here. Do we have any item of PP which was acquired? We have to prepare the PP account. Maybe first of all, you can ignore that because there is no obvious item you can record here. But also recall what we said is that if, for example, you're given maybe an investment income which was received, or basically interest which was received, that one should also be considered share. So maybe you can just go to where we have equity and current liabilities. Equity and current liabilities, we see whether there are some obvious items we can be able to record. Other financing. Are there some obvious items we can be able to record here? So let's go to where we have equity. Equity, the first item we have there should be share capital. Did the share capital change? Yes. The share capital increased from 32 to 40. And because the question is silent, automatically we assume that these are shares which were issued for cash. So we have issue of ordinary shares, which is basically equal to the increase, and that is 8. That is 8. And then from there we have share premium. So share premium equally increased. So that increase in the share premium is also considered here because these particular shares which were issued are the ones which were issued at what? At a premium. And basically that is an amount of what? The increase in share premium is 400, which is still an inflow. The moment the company issues shares and the shares are issued as a share premium, that is basically an inflow. The valuation reserve, do we consider that here? No, because that is an uncash item. And then from there, we have the retained profit. And basically, this is a retained profit. This one is basically used in terms of computing the dividends which were paid. I hope you can be able to recall how are we computing the dividends which were paid. So to compute this, we said we take the retained earnings at the start. The retained earnings at the start. The retained earnings at the start of the year were 42,400. 42,400. And then to this, we add the profit after tax or the profit for the year from the income statement. How much is the profit for the year from the income statement? The profit for the year from the income statement is 13,870. 870. And then to this, we minus the retained earnings at the end. The retained earnings at the end is basically an amount of how much? 52,770. 770. And basically we will get this. So that will give us an amount of how much? That will give us an amount of how much? Will give us dividends paid of how much? Dividends paid of how much? Dividends paid of how much? Yes, dividends paid of 35. Remember, dividends paid is a cash what? Is a cash outflow. Is a cash what? Is a cash outflow. Is a cash what? Cash outflow. So therefore, that question basically, you may decide to leave it at that point. You may decide to leave that question at that point. Because remember, in this case, you don't have all the time to do all the workings. So if you leave it at that point, how many entries do we have? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So even if, for example, the question is marked like this, because the marks are located here, how many marks were located? The marks allocated were basically 20. 20. Mostly the question may be marked like this. Any 20 correct entries at 1, you get 20, or any 20 at 2. Not 20 at 2, but rather any 10 at 2. You get how many marks? You get 20. Most likely, and it is a easy long questions, the question for group, the question for published, including the question for cash flow. This is usually how the questions are marked. For every correct entry which you have here, how many marks? You basically get 2 marks. So mean that if that's basically how the question was marked, you can see even without having computed a number of items like depreciation, like the PP which you acquired, you can get you will get all the marks. Even if now, on the other hand, the question was you are to get 1 mark for every correct entry, I hope you can remember you have counted 16 correct entries here. So it basically means that that question, you have over 15 marks. Over 15 what? Marks. And basically, you can see that question. If you use that particular approach, you should be able to finish the question within the 40 minutes we talked about. And basically, you're able to move to the other question. Because we said, as far as these particular questions are concerned, other than knowing how to handle them within an examination setup, you should be able to do the question within a short period of time, the 40 minutes. And basically, you are able to get good marks. And then you move to the other you move to the other question. So therefore, if you happen to come across this question, make sure you use that particular approach. That approach, don't struggle with those particular workings. Maybe you feel they are a little bit what? They could be a little bit complex. They could be a little bit complex to do what? To compute. To compute, yes. So what I want us to do, we just take a short break, then we come back, we do another question for cash flow. For cash flow. Yes, so which question should we do after the break? I think this is an area which was highly examined. I think, is it 2022? Yes, 2022, I think we basically have a number of questions, and I think we don't have the papers for 2022 there. So those which have done here for 2023. I think we did the question for 2022. The question for Maram. I hope we did that question. The question for Maram, Yes, I think we did that one. We did that question, sir. We did that question. Okay. Yes, I think we equally have other questions from those particular past papers. And there was a question which was a little bit complex there. I don't know which it is from which sitting, but I think should be from 2020. Should be from 2022, if I'm not wrong. Should be 2022. 2022. Yes. Can you just be checking on those particular past papers? And then we take a short break of 10 minutes. We come back at 9:15, and then we continue. We do another question on this using the same approach. We come back at 9:15. Yes, so August of 2023. Question number 4. Question number 4, part A. Yes, so what are we told here? So the question reads that 𝐷𝐉𝐎 Limited is a public limited company. Details of the company's statement of financial position as at 31st of March 2022 and 31st March of 2023 are shown below, together with other relevant information. So we have the statement of financial position. We have the non-current asset, which include PPE, intangible assets. And then we have the current asset, which include inventory, receivables, interest receivable, short-term deposit bank. We have share capital, which comprises of ordinary share capital, share premium, revaluation, retained earnings. Non-current liabilities include 12% loan notes, 8% loan, that is variable rate loan notes, deferred tax. Under the current liabilities, we have trade payables, bank overdraft, taxation. We have additional information about 1, 2, 3, 4, 5, 6. So what are we required to do? We are required to prepare the statement of cash flows for 𝐷𝐉𝐎 Limited for the year which ended 31st of March 2023 in line with IAS 7. So we are required to prepare the statement of cash flows of this company. And basically the company is called 𝐷𝐉𝐎 Limited. This is the statement of cash flows. The statement of cash flows, basically for the year which ended for the year which ended basically when 31st of March 2023. 31st of March 2023. And equally, you can see in this question, as far as this question is concerned, the examiner is not even specific on which method to be used, whether to use the direct method or basically indirect method. But recall what we said, in case you're given the statement of profit or loss, statement of financial position, the examiner is silent on which method to use. Then in this case, we said always use the indirect method. Use the indirect what? Method. So here we need to have our three columns, and that not column, rather three subheadings for getting the cash flow from operating activities. And the values here are basically given in million of shillings, are given in million of what? Of shillings. Yes, so then from there we have the other subheading for getting the cash flows from investing activities. From investing activities. And then from there, cash flow from the financing activities. So basically all the items which we record here, we get them from equity and basically the non-current liability section in the statement of financial position. And then finally down here, we record what? We record the cash and cash equivalents at the start of the year, and then the cash and cash equivalents balance carried down, which is basically at the end of the year. So can we start by recording this? We start by recording the cash and cash equivalent at the start and also at the end of the year. At the start and also at the end of the year. At the start and also at the end of what? Of the year. Remember, we have said that we get these particular items where we have the cash. That is the current asset, not the cash, where we have the current what? Asset. So can we go back to a statement of financial position? Specifically at the current assets. So at the current asset, do we have cash and cash equivalents there? In our case, we are not given the cash and cash equivalent. That cash and cash equivalent is not given like the other question. So what we consider here is cash in hand, cash at bank, and then short-term investment. So therefore, what do we have there? Which component of cash and cash equivalent do we have there? We have inventory receivables. Those are items of working capital. Interest receivable, that one, we are going to use it in computing the amount of interest which was received. So that one is not equally part of cash and cash equivalent. But I hope you can see we have short-term deposit. Short-term deposit, basically, this is deposit in a fixed deposit account. This what we refer to as the demand deposit. I hope you can be able to remember, explain what is demand deposit. So this is part of the cash and cash equivalent. So we take the cash and cash equivalent at the start. Remember, you're given 2 years, 2022, 2023. The values in 2022 are the opening balance. So short-term deposit in 2022 is basically an amount of 120. And then we can also record the closing balance here, which is basically 32, because that will be cash and cash equivalent at the end. And then what else do we consider here? We consider the bank balance. The bank balance at the start is basically 75. And then the bank balance at the end is what? Is 15. Then we go to where we have current liabilities. We check whether we have an overdraft. Can we go to where we have current liabilities down there? Do we have an overdraft? Yes. So an overdraft, we consider that here, but basically overdraft, we consider it here as a negative. It's money which is owed to the bank. So the bank overdraft at the start is basically zero. What about the bank overdraft at the end of the year? Is 125. 125. So in this case, we will be able to get the cash and cash equivalent at the start and also at the end of the year. So this plus this will give us 195. And then this will give us around 47 minus 125, which will give us negative something. So what are we going to have there? That should be 110, 70 what? 78. which is the basically a negative. Is it a negative or positive, Anna? That one should be a negative. That one should be a negative. Negative, eh? Negative 78. Yes, negative 78. So basically, those are the obvious entries we can record there. Then we go back to the income statement, and we basically check what you're given there. In the income statement is part of note 4. Note 4. In note number 4, what do we have there? We have operating losses, we have interest receivable, finance costs, and then we have what? We have the profit. Actually, we have loss. So we have loss before tax. So what we do here, we start with the loss. Remember, in all questions which you have done, we have come across questions where we had profit. So we were starting with the profit before tax. So we start with the loss before what? Before tax. Before tax. So the loss before tax is basically 44. And I hope you can see that is a negative. Make sure you record this as a negative. As what? As a negative. And then we make a number of adjustments. A number of adjustments to this loss. So the first adjustment automatically should be to add back the finance cost. So the finance cost should be above this. Do we have the finance cost? Yes. We have a finance cost of 24 there. Sasa, we add it back. Then also there in this question, we have something called interest receivable. Now, interest receivable, in other terms, this one we refer to it as an investment income. So that investment income was treated as an income in computing this. But is that an income generated from operating activities? No. We said any interest received, that is an income received from investing activities. So therefore, that amount which you're given there, which is 12, and which is added in arriving at this, we have to rest it here. So the interest receivable, the reason why we are deducting it is because this is not an income from operating activities. This is an income generated from investing. So we deduct it from this, and then we consider that here. But basically what we consider here is the actual amount of interest which was received. Remember, under the current asset, I hope you can be able to recall, under the current asset, we were given something called the interest receivable. Can you remember that? Interest receivable? Yes. So just like how we compute the interest paid or the finance cost paid, we will use the same concept we have used in computing the finance cost paid. So we will go to where we have the current asset. We take the interest receivable at the start. The interest receivable at the start is 3. And then we add the interest which was supposed to be received during the current year from the income statement, which is basically 12. And then we less the interest receivable at the end, just like how we have computed the interest which was paid. This will give us 15 minus 5, which basically will give us what? 10. And this is an interest received. Being an interest received, this one is a cash inflow. Is a cash what? Inflow. Sasa? Yes. So that basically what we have on the face of the income statement. Then from there, remember here, we also consider the non-cash items, dial G. So let's go to the additional information. We see which obvious entries we can be able to pick. In note number 1, this note number 1 requires so many workings. So I don't know whether there is an obvious item we can be able to pick from there, but I think we can ignore note 1 because you needed to prepare so many accounts there. So let's go to note number 2. Note number 2, we are told the company revalued the carrying value of rented buildings with an increase of 70. This one is not considered here. Remember, this is a revaluation gain. And then you're told on March 2023, it's transferred 3 million from revaluation reserve to the retained earnings. to the retained earnings relating to the depreciation on the revaluation of buildings. So any item you can be able to bring there? No. So we go to the other note, number 3. We are told during the year, the company acquired a new plant at a cost of 60 million. This is a plant which was acquired. So a plant which was acquired is an investing activity. So we talk of acquisition of what? Acquisition of plant. This is a plant which was purchased at a cost of 60 million. So that one we recorded here as a cash outflow, like that, as a cash outflow. And sold an old plant for 15 million, incurring a loss of 12. So also 2 free entries. So we also have disposal. We also have disposal of old plant. And remember what we consider here is the sales proceeds. This old plant we are told was disposed for 15 million. So that is basically a cash inflow. We record it there. And then you are told this old plant was disposed at a loss. There was a loss on disposal. There was a loss on what? A loss on disposal. A loss on disposal of how much? Of 12. So remember, these 4 items should be added. For last, this one should be deducted. So we have a loss on disposal to be added to our loss there of 12. Yes, so in that case, we have gotten, I think, like 3 entries from that point. Then note number 4, I think we have dealt with that because that is already the income statement. Note 5, we are told the short-term deposits are deemed to be cash equivalent. So basically, I've said if you're given short-term deposit, even if the question is hidden, that one should always be considered here as part of the cash equivalent. I think we have already done that. Number 6. Dividends of 25 million were paid during the year. Where do we record dividends paid? Here. So we are given the dividends. We are given the dividends which were paid. Dividends which were paid, and basically which amounted to 25 million. Remember, these are cash outflow. Recorded says a negative. Recorded says what? Is a negative. So basically, you can see that question by first of all doing that. You can see the number of entries we have here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If, for example, you're given 1 mark for each correct entry, we already have 10 marks. We have not done anything. So then from there, what we need to do here, we come and we consider what? The changes in working capital. Remember, I've said that these are always free marks. The free marks here, the 3 free entries. That's huh? Yes. So we consider that here, the changes in working capital. So therefore, even if you happen to come across a question which is a little bit complex, like this is one of the hardest questions which has ever been tested on cash flow. This one is one of the hardest one because so many workings which are required, especially in that note number 1, there are so many items which you have to compute. So here we get these marks. So basically, I'm saying even if you happen to come across a question which is very, very difficult, you need to get some marks. You need to get some marks here, because there are always some free what? Some free marks. So we consider basically 3 items here: receivable, inventory, payables. This is the formula: opening minus closing, opening minus closing, and then closing minus opening. Sasa, yes. Hizi marks tumesema hizi lazima upate. Kwa hiyo swali ya cash flow, make sure you get those marks here. So can we go to where we have the current assets? Current assets. We start with the inventory. Inventory, we take opening minus closing. For 20 minus 350. For 20 minus 350, that is inventory. That basically will be negative 70. Is it negative 70? Is it negative 70? Negative 70, is that what you're getting? Negative 70. Yes. So then from there, below that, what do we have? We have receivables. We take the same. Opening minus closing. 372 minus 808. 372 minus 808. What are you getting? 436. Yes, we tried to hurry up. 436, which is equally a negative And then finally, payables. Payables is part of the current. Edith, that is a positive. 372 minus 808. That one is negative. That one is negative. That one is what? Negative. 372 minus 808 is negative. Huh? Inventory. Oh, inventory. This one. Okay, sour. So this one is positive. Okay, thank you. Okay, so then we have payables. Payables, we have 515. Okay, closing minus opening. 530 minus 515. We have positive 15. Positive 15. Okay, so then from there, down here we consider the interest which was paid, or the finance cost which was paid. So we just need to consider two items. So we go to where we have current liabilities. We check whether we have any accrued interest. Do we have any accrued interest under the current liabilities? No. It basically means that the interest which was paid is the finance cost which we have in the income statement, this one. And I hope there is there is a note which is given in relation to this. In note number 4. Note number 4, can we go to where we have note number 4? Note number 4, below the income statement, or basically below where we have the loss for the period, we are told the finance cost, this one, finance cost, is made up of interest expense of 18 million and the penalty on early redemption of 6. So what we should consider here is not the full amount. We should consider the interest expense. The interest expense is 18 million. So the penalty on early redemption is not part of the finance cost. So we consider 18 million only. 18 million only. So then tax paid. Tax paid here, we need to prepare the tax account. Tax account, what do we have under the non-current liabilities? Under the non-current liabilities in our statement of financial position, we have the deferred tax. And I think under the current liabilities, we also have the current tax. So we will record the deferred tax at the start and also at the end. So first of all, can we record the deferred tax at the start? Deferred tax at the start was 75. Deferred tax at the end was 90. Under the current liabilities, we have taxation at the start 110, at the end 15. Then what about the income statement? In the income statement, which is in note number 4, do we have below the loss before tax? I hope you can see equally here. We don't have income tax expense. Number 1, we have the income tax repayment claim. Income tax repayment claim, and then we have the deferred tax charge. Now, how do we record those items here? Now, first of all, the deferred tax charge, you can see that one is recorded as a negative. In other terms, that is a deferred tax expense. A deferred tax expense, that one should be credited here, deferred tax expense. Deferred tax expense, because that is an expense. We credit it here, we debit it in the income statement. How much is that? That is basically an amount of 15. But now, for the current tax, you can see it is income tax repayment claim. In other terms, this is what we refer as a refund for, this is what now we refer to as a claim for a tax refund. A claim for a tax refund. A claim for a tax refund is not basically an expense, but that one is like an income. Do we credit it there? No, we basically debit it here. So tax refund, or basically claim for tax refund. Claim for tax refund. Claim for tax refund. Claim for tax refund. Which is an amount of 14. Which is an amount of what? 14. You can see this question was a little bit complex, as you can see. I think that's what we have. As per note number 2, I don't think we have the deferred tax on revaluation gain. As per that point, we don't have deferred tax on revaluation gain. So let's balance this account, and I think we will be able to get the tax which was paid as the balancing figure. The tax paid will be how much? The tax paid, I'm told, will be 81. So the tax paid is 81, is 81, is 81 like that. Yes, so basically that's what we have. And I think we have recorded that. Then maybe here we have said we consider asset, acquired asset disposed. Maybe we can just go to where we have non-current asset in our statement of financial position. I've said for PP, let's ignore that. That one has a lot of work. Intangible asset, I think we can deal with that. Intangible asset at the start, 510. And then at the end of the year, we have 400. The value for intangible assets reduced. Now, two reasons why the value for intangible asset can reduce. One is due to disposal or sale. In case the company sold some asset, we said you must be given some information on that. The other reason why the value for intangible asset can reduce is amortization. Automatically, because in the additional information, there is nowhere we are told intangible asset was sold. So automatically, that is what? That is amortization. That is what? Amortization of intangible assets. Amortization of intangible asset, which is basically the decrease. And that is a decrease of what? Decrease of 110. Decrease of 110. Decrease of 110. Decrease of what? 110. Yes, I think nothing else we can capture there. Then can we go to where we have equity and current liabilities? Equity and current liabilities. Equity and current liabilities. Equity and current liabilities. So under the equity, what do we have? We have the 12% loan notes. The 12% loan notes, their value at the start was 150. And then at the end of the year, the value reduced to 0. So what causes the value for loan notes to reduce to 0? From 150 to 0? What causes the value to reduce to 0? What causes the value to reduce to 0? This basically, remember there is something we are told in note number 4. Redemption. The penalty for loan redemption. This is basically what we refer as the repayment or redemption. Yes. So we can talk of repayment or just redemption. That is basically one of the same thing. Redemption of 12%. 12% loan notes. Now, we need to consider how much amount was paid. The amount which was paid is equal to the principal amount, 50 to 0. That is, the amount which was repaid is 150. But remember in note number 4, we are told that these loan notes were redeemed early. The company incurred a penalty as per note number 4, where we are given the composition of the interest. So there was a penalty of 6. So the company paid a total of 150 plus a penalty. So the amount which was paid on redemption is how much? 156 million. That is the amount which was paid on redemption. So we go back to where we have non-current liabilities. We have dealt with the 12% loan notes. Below that, what do we have? We have 8% variable rate loan notes. The value at the start was 0. At the end of the year, the value increased 160. So these are loan notes which were issued during the current year. That's why the value increased. So we can talk of issue of 8% variable rate loan notes, and basically the amount received is equal to the increase, which is how much? 160, which is a cash inflow, We are done with that because we have dealt with the deferred tax. Then can we go back to the equity? Equity, I think we start with the share capital. Share capital has increased. So the reason why the share capital increased is because of shares which were issued for cash. Issue of shares, which is an increase of 100, which is basically a cash inflow. Below that, we have a share premium. Share premium increased from 0 to 60. So this is the amount which was received in form of share premium from the issue of shares. We talk of increase. We talk of increase in what? In share premium. The share premium increased with 60. with 60. Below that, what we have is the retained earnings. That one is used in the computation of the dividends which were paid, but we already given the dividends. But in this question, we can't be able to use the retained earnings to compute the dividends because of some information we have in note number 2. I think that's why the examiner had simplified that by giving you the dividends already paid. And then below the share premium, we have revaluation surplus. We don't consider that here, the retained earnings. Now, that question just leave it at that point. And despite the question being challenging, you can see we have so many entries which you have been able to make here. That's basically how you handle this particular question. It's not a must that you have to do those very complex workings, just record the obvious entries. And of importance here, as you revise this particular question for cash flow, can you be able to identify those areas whereby you get 3 marks? Kama hapa, cash and cash equivalent at the start and at the end, easy changes in working capital, these are 3 marks. Na hapa kuna marks mingi sana za free. This profit or the loss before tax, the finance cost, that is something tumerecord kwa zile maswali zote tumefanya, and then other entries here. So basically what I request is that the 2 questions which we did in class, don't even do any other new question from the past papers. Just go back to the questions, to the 2 questions which we did, and can you do them using this approach? You do them using this particular approach, and you see how many entries can you be able to make in that question without those complex workings, without those complex workings, and then you count the number of entries you have been able to make. Like this question, you can see how many entries do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So even if, for example, we were given 1 mark for every correct entry, you can see we already have the 20 marks. Sasa, yes, that is basically the approach to be used in tackling these particular questions. In tackling these questions. So if you happen to come across a question maybe from this topic, make use of that. Use that particular approach. Don't use the other approach we're using in class, starting in the workings and then preparing the statement of cash flows, because generally we say you don't have the time to do that work. If you do that question like that, that is I'm sure you'll be able to handle the question within 40 minutes, and basically you will be in a position to get more than 15 marks or even 20 marks. Because remember what I've said that in most of these particular questions, December 2023, specifically question number 3C. Question number 3C. That is December of 2023. Question number 3C. Question number 3C. So let's go to this particular question here. We got to this particular question here. We got to this question here. So if you are there, maybe you can just confirm. Yes, December of 2023. Question number 3C. 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 Are you there? December 2023. Question number 3C. Question number 3C. Question number 3C. Question number 3C. 3C. Okay. So we are saying basically this is a question regarding the computation of impairment loss. Maybe even before you look on the question, just quick recap on what we said regarding computation of impairment loss at the International Accounting Standard number 36. So basically we said, first of all, an impairment loss. This is the difference between the carrying amount of an asset and something called the recoverable amount. So when we talk about the carrying amount of the asset, this is the same with the net book value of the asset. We know how to compute the net book value of an asset. We take the cost minus the accumulated depreciation. On the other hand, when we talk about the recoverable amount, we say that basically this is the higher of two values. The higher of two values. Number one, something called the net realizable value. The net realizable value is also called the fair value, less cost to sell, less cost to sell. So net realizable value, therefore, is the estimated selling price of an asset minus the cost which will be incurred by the company selling that asset. If the company wants to sell an asset today, that asset will be sold at how much? And then we less the cost which will be incurred in order to sell that asset. So that one is called the net realizable value. So we take that, or number two, something called the value in use. The value in what? In use. Now, what is the value in use? The value in use, we say that this one is the present value of the estimated cash flows, to be generated from the continued use of the asset, or basically to be generated from the use of the asset and also from its disposal. So here, for you to be able to compute this particular value in use, you'll be given the cash flows, the estimated cash flows to be generated from the use of the asset, and how much amount the asset will be sold at the end of its useful life. So you discount those particular cash flows. So therefore, you take the higher of these two values, and basically that one is called the net realizable value. Essentially, what we said is that according to IAS 36, an asset is said to be impaired if the recoverable service amount is not recoverable service amount, but the recoverable amount is actually less than the carrying amount, in which case then we say the entity should proceed and recognize impairment loss. Now, generally what we say is that this particular impairment, or according to IAS 36, an impairment review should be conducted at the end of each year if there is a factor or maybe indication of impairment. Now, in this case, we say that there are a number of factors which could show that the asset could be impaired. Like a good example is whereby an asset has been physically damaged. Maybe the company bought an asset like motor vehicle. That motor vehicle has been involved in an accident. It has been damaged. Or number two is maybe the performance of an asset being lower than what was originally expected. Or maybe there is adverse changes to the use to which the asset is put to. Maybe the asset is used for manufacturing a product which is exported, but in this case, we are told that the government has imposed some restriction regarding the export of that particular product. The product cannot be exported. So mean that we have some adverse changes as far as the use of that particular asset is concerned. All those are factors which could show that the asset could be impaired. And therefore, we said if there exists such a factor which shows that the asset could be impaired, an impairment review should be conducted. And actually, we said impairment review entails comparing these two values, carrying amount to recoverable amount. If this one is found to be less than the carrying amount, then an entity should proceed and recognize an impairment an impairment loss. An impairment loss, which is basically the difference between those two values. Now, let's go back to our question here, the question for December of 2023, which is basically question 3C. So what are we told here? So we are told that a division of 𝐍 Limited has the following non-current assets, which are stated at their carrying amount as at 31st of December 2022. So we have goodwill, the carrying amount for that is 70. Property, plant, and equipment, which comprises of two assets, landed buildings, carrying amount 320, plant and equipment 110, and basically the total for those two carrying amount is 430, meaning that the total carrying amount of this of the asset in this division, this is 500 million. And remember, in this case, whatever you're given here, a division is basically like a department. So we say that those particular, or actually a division, or in other terms like a branch, this one is actually regarded to be a cash generating unit. So a cash generating unit, basically we said, is a group of assets which generate cash flow as a group. It basically means that if you take one of the assets from that group, it cannot be able to generate cash flow on its own. And therefore, what we said is that we always determine the impairment loss, not for individual asset, but we determine the impairment loss for all the assets within that particular group. And then from there, we do we allocate that particular impairment to the individual asset. So this therefore is a cash generating unit. So we are given the three assets in that cash generating unit: goodwill, land and buildings, and then we have the plant and machinery. That is the carrying amount of 500. And then you're told, since the assets are used to produce a specific product, it is possible to identify the cash flows arising from their use. And the management of 𝐍𝐲 Limited believes that the value of this asset may have become impaired because major competitor has developed a superior version of the same product. So, and then you're told that forecast cash inflows arising from the use of the asset are as follows. So what you're given there are the forecasted cash flows. So these particular forecasted cash flows are for computing what? These ones are for computing what you have referred to as the value in use. Remember, you have said value in use is the present value of the estimated what? Cash flow. So we're given estimated cash inflows for the next 3 years, 2023, 2024, 2025, and basically some amount there in million of shillings. And then you're told the following additional information is also useful. Number one, you're told the directors are of the opinion that the market would expect a pre-tax return of 12% on an investment in the entity that manufactures a product of this type. So we are given something called the pre-tax cost of capital, and basically we'll be able to explain why we use that. Number two, you're told the land and buildings are carried at revaluation, and then you're told the surplus relating to the revaluation of land and buildings that remained in the revaluation surplus reserve as at 31st of December 2022 is 65 million. And then we are told that all other non-current assets are carried at historical cost. Final number three, we are told the goodwill does not have a market value. And then you're told it is estimated that land and buildings would be sold at shillings 270 million, and the plant and machinery would be sold for 50 million net of the direct selling cost. So what are we required to do in Roman 1? We're required to calculate the impairment loss to be recognized in the account of 𝐍𝐲 Limited. Roman 2, we're required to explain how the loss, that is the impairment loss, would be treated in the financial statement for 𝐍𝐲 Limited as at 31st of December 2022. So we're going to start with the Roman 1. And basically Roman 1, we are required to compute the impairment loss. The impairment loss to be recognized in 𝐍𝐲, in the account of 𝐍𝐲. So basically we are required to compute the impairment loss of this division. Remember this division, this one we have said is a cash generating unit. This one is basically a group of assets which generate cash flow as what? As a group. So we are required to compute the impairment loss and basically of cash generating units as at 31st of December 2022. 31st of December 2022. So what we just need to recall is the formula for computing the impairment loss. Impairment loss, this one is equal to the carrying amount minus the recoverable what? Minus the recoverable amount. So what we need to do here is to basically determine those two particular values, the carrying amount and the recoverable amount. So this carrying amount, this is something we are given below paragraph 1. If you go to the information we have below paragraph 1, we have the carrying amount of this cash generating unit. And remember, I've said the cash generating unit is a group of assets. So therefore, the carrying amount is not the carrying amount for individual asset, but the carrying amount for all assets. So therefore, the carrying amount basically here will be 500 what? 500 million. So that is basically the carrying amount. Then from there, we need to proceed and basically we determine the recoverable amount. Now recall, we have said that the recoverable amount, this one is basically taken to be the higher of two values. The higher of two what values? The higher of something called the net realizable value, which is also called the fair value, less cost to do what? Less cost to sell. Less cost to sell. So the amount at which an asset can be sold at minus the cost to sell. Do we have this particular information? Do we have the net realizable value less cost to sell? Yes. This one is given in note number 3. So can we go to note number 3 of our question here? So in note number 3, we are told that the goodwill, the goodwill does not have a market value. So meaning that if the company decides to sell this division, so out of the 3 assets, because I hope you can see below paragraph 1, this cash generating unit or this division has 3 assets. So if the company decides to sell this division or this cash generating unit, so goodwill will not fetch any amount of money. So the value for goodwill is 0. The market, the fair value of goodwill is 0. And then you're told still in note number 3, it is estimated that landed buildings could be sold at 270 million and plant and machinery could be sold for 50 million net of the direct selling cost. So when talk about the direct selling cost, that is basically what we refer as the cost to sell. So therefore, we can be able to compute this because we know that this cash generating unit comprises of how many assets? 3. So we need to add the net realizable value for the 3 assets. So we are told the goodwill. Remember, this cash generating unit has how many assets? 3. So the value for goodwill or the net realizable value for goodwill is 0. Then for the other 2 assets is still given in note number 3. For the other asset that is landed building, as per note number 3, we are told is 270 million. So if the company decides to sell landed buildings today, they will be sold at 270 net of the selling cost. What about the other asset that is plant and machinery? Plant and machinery, we are told as per note number 3, they can be sold for 50 million. So basically what that means is that the net realizable value less cost to sell, this one would be 320 million. 320 what? Million. So we already have that. So next, what we need to do is basically to determine the other value, which is basically what? The value in what? In use. How do we compute the value in use? The value in use, this one is equal to the present value of the estimated cash flows. The present value of the estimated what? Cash flows. And I hope you can see below the information. In the information we have below paragraph 2, or basically paragraph 3, we are given the forecasted cash flows. So what we just need to do is to discount those particular cash flows. And when discounting these particular cash flows, we discount them using something called the pre-tax cost of capital. So the pre-tax cost of capital is what you're given in note number 1. We are told the directors are of the opinion that the market would expect a pre-tax return of 12%. Now, this basically what we use for discounting. So therefore, what we need to do is basically to discount those cash flows. We will have our 3 years, here. The first year basically ended on 31st of December 2023. The other year, 31st of December 2024. The other year, 31st of December 2025, like that. And then we have the cash flows, the estimated cash flows, We are going to work still with those particular figures in million of shillings. We have 185 million. We have 160 million. We have 130 million. So how do we discount this? So we need to multiply this with the present value interest factor at the rate of 12%, which is the pre-tax cost of capital. And then from there, we will get what? We will get the present values. We will get the present values. Remember, which formula do we use in computing this? We use this formula 1 plus r raised to power negative n, Remember, you say that when it comes to FR, it is important for you to recall all these formulas. The examiner will not give you those present value interest factor tables. You have to remember all these particular formulas. So let's work out this. So in the first year, we will have 1.12, basically raised to, we raise that to -1. We raise that to power -1. We raise that to power -1, and that will give us 0.89 to 4 decimal places, 8920, 29. I hope that is what you're getting. So for the other year, you're getting what? Year 2 should be 0.7972, and basically year 3 we have 0.89. 7118. 7118. Yes, I hope that is basically what you're getting. So then from there, we need basically to move and you multiply these particular values so that we can have the present values. So we start with the year 185 times 0.8929. 0.8929. So that will give us what? Maybe to the nearest whole number. To the nearest whole number. Let's just work with that to the nearest whole number. We work with that to the nearest whole number. To the nearest whole number. To the nearest whole number. Are you getting 165? Are you getting 165? Yes. So what about the other year? The other year I'm given 128 million. And the last year, that is the year 3, 130 times 0.7118. 92, 92 or 93? 93, yes, 93 million. 93 million. So we add all this, and basically what we get here is basically the value in use. The value in what? The value in use, the value in use. So the value in use here is basically 386 what? 386 million. So having that, having the two values, the net traceable value and the value in use, we take the figure which is higher. We take the higher of the two. So the higher of the two between 320 and this one. So basically the higher of the two will be what? 386. 3 what? 386. So therefore, we can say that the recoverable amount is what? Is 386 million. So having that, we need to confirm, or basically we need to check whether this particular cash generating unit is impaired or not. Remember generally what you have said, that an asset or even a cash generating unit is said to be impaired if the recoverable amount, this one, is less. This one is basically less than the carrying amount. Remember, our carrying amount is 500 million. And then this one is 386. So we need to check, is this one less than that? Yes. So that is the case. So the recoverable amount is less than the carrying amount. So if that is the case, then we need to move and basically we determine the impairment loss. So the impairment loss, we compute that using our formula here. Carrying amount minus the recoverable amount. Carrying amount is 500 million minus the recoverable amount, which is 386 what? 386 million. And that will give us a value of what? Douglas is asking about what? Which 65 are you referring to? Douglas. Which 65 are you referring to? There is something we have omitted here. Let me see. No. I will explain why we use that. I'll explain why we use that. That one should not be added here. We are told the buildings were revalued some time back. So the amount which is included here is the revalued amount. So I'll be able to explain why we use that revaluation, the revaluation gain. They were not revalued during the current year. I'll be able to explain why we use that. Yes. So this will give us impairment loss of what? 114 million. 114 million. Is that not the revaluation loss, impairment loss? Yes. So that is basically the impairment loss, and that is what was required in Roman 1. So by doing that, the marks are located there were 6. So we move to Roman 2 of the question. In Roman 2, what are we required to do? We're required to explain how the impairment loss, or actually how the loss will be treated in the financial statement for the year, which ended 31st of December 2022. The treatment of what? Of impairment loss. Treatment of impairment what? Loss. Impairment loss for the year which ended 31st of December 2022, the treatment of impairment loss. Now, what the examiner basically was testing here is whether you can be able to record what we said as far as the treatment of the impairment loss is concerned. So we said how we account for the impairment loss always depend with how the assets are carried in the statement of financial position. So the treatment of the impairment loss will depend with whether the assets in the statement of financial position are recorded at historical cost or they are recorded at the revalued amount. That's basically what we said. Number one, we said for those particular assets, this first of all a quick recap on what we said. For those assets which are carried at historical costs. So these are those particular assets which have never been revalued. Like I think in our case, we are told in that note 2, which Douglas is asking about, there is an asset which was revalued. So these are those assets which have never been revalued. So any impairment loss relating to this particular asset, the full amount is recognized as an expense in the income statement. That is the first thing you need to remember. The full amount of impairment loss for such asset is an expense in the income statement. But number two, we have those particular assets which are carried at revalued amount. These are some those assets which were revalued maybe some time back. So in this case, we said that the impairment loss relating to this particular asset, is not the full amount is not recognized as an expense in the income word, is not recognized as an expense in the income statement, but basically the amount which is recognized as an expense in the income statement is the excess amount. Is the excess what? Amount. So the excess amount, or basically the amount of impairment loss, which is in excess of any revaluation reserve, which is in excess of the revaluation what? Reserve. Like in this case, we are told landed buildings were revalued some time back. There was a revaluation reserve relating to those particular what? Assets. So the revaluation, the amount of impairment loss which is in excess of the revaluation reserve is now what we recognize as what? As an expense in the income statement. No need to worry, Raphael. I'll be able to, because we are this is just a recap, and we're going to look on how we account for that. When accounting for that, maybe you'll be able to understand that better. Sasa, yes. So this is basically a quick recap on what we said in relation to this. But you can see the marks allocated here are basically significant marks because they were 6 marks. They were 6 marks. So the first thing we are going to do in relation to this particular impairment loss, first of all, we have to share it. We have to share this impairment loss among the assets within this cash generating asset. Remember, there are 3 assets. So that impairment loss should be allocated to all the assets. Should be not allocated, rather, it should be shared among, or in other terms, it should be allocated to the 3 what? Asset. And then from there, we will be able to explain how to account for that particular impairment loss as required in our question. So therefore, we will say the impairment loss of 114 million should be allocated to the assets. Should be allocated to the assets within the cash generating asset, within the cash generating unit. So being allocated means that particular impairment loss will be shared among what? The asset within that cash generating unit. And we said when sharing or allocating this particular impairment loss, there is a certain order to be followed. There is a certain order to be followed. So therefore, the impairment loss will be allocated to the asset in the CGU in the following order. In the following word order. So this is basically the order to be followed. The order to be followed. Number one, the impairment loss should be allocated to the assets obviously impaired. Assets obviously impaired. Assets obviously impaired. Now, when talk about the assets which are obviously impaired, we say that these are those particular assets whose net realizable value or whose fair value is 0. So these are basically assets whose net realizable value, or basically the fair value, is 0. So if the company decides to sell this particular cash generating unit, those particular assets will not fetch any amount of money. Like, I hope you can be able to recall in note number 3 that if the company decides to sell this particular cash generating unit, which comprises of 3 assets, goodwill will not fetch any amount of money. So that is an asset which is obviously impaired. Its net realizable value, its fair value is basically what? 0. First of all, allocate impairment loss to those assets. Number 2, then allocate to goodwill. Allocate the impairment loss to goodwill within the cash generating unit. And number 3, allocate to other assets. To other assets, based on the carrying amount, or basically based on their net book value, based on their carrying amount or based on the net book value. So that's basically how we need, first of all, to allocate this impairment loss, to share this impairment loss among the assets within that word, within that cash generating unit, Yes, so basically what we need to do here, we need first of all to check, and basically when considering the assets which are obviously impaired, though I've given goodwill as an example, we don't consider goodwill because you can see goodwill will be allocated impairment loss as the second asset. After allocating the assets which are obviously impaired, goodwill comes to number two. So therefore here we consider the assets which are obviously impaired, asset whose net realizable value or fair value is 0, except, or actually excluding goodwill. Goodwill should not be considered here because you can see that comes to number 2. So therefore what we need to do is we consider whether there are assets which are obviously impaired. Do we have assets obviously impaired? Obviously impaired. Now, as per the information which we have in note number 3, there is no asset which is obviously impaired. Basically, goodwill, yes, actually, that is another name which I used, I think, when we were going through this particular topic. In other terms, we can say that these are those assets which are worthless. They do not have any value. They are worthless assets. So in note number 3, except goodwill, which you're saying we don't consider goodwill here because you can see goodwill comes to number 2. So there is no asset which is worthless because there are 3 assets. And actually we are told the other 2 assets, land and buildings, plant and machinery, they can be sold. So therefore, other than goodwill, no any other asset which is obviously impaired. Number 2, we then allocate goodwill to, we then allocate impairment loss to goodwill. And basically, what we need to do here is to determine how much is the carrying amount of goodwill. How much is the carrying amount of goodwill as per the information we have below paragraph 1? The carrying amount of goodwill is how much? Who can be able to see the carrying amount of goodwill? Yes, the carrying amount of goodwill is 70 million. Is 70 million. Is 70 what? Million. Now, we need to ask ourselves, out of this impairment loss of 114 million, how much amount are we going to allocate to the goodwill? And remember, in this case, we said, once we have allocated impairment loss to an asset, impairment loss reduces the value of an asset. Sasa? Yes. So in this case, we said, take into account the carrying amount, or take into account the carrying amount of goodwill is 70, we can only allocate impairment loss equal to carrying amount, such that after allocating impairment loss of 70, we reduce this to 0. There is no way we can reduce the value of an asset below 0. Maybe we reduce an asset to negative. No. So therefore, the impairment loss to be allocated to this will be 70 million. That is the impairment loss to be allocated to that what? Asset. After doing that, we will now, the value for goodwill reduces to 0 because we are told goodwill has no resale value, or basically the value goodwill is worthless. So then the remaining impairment loss, out of our impairment loss of 114, we have allocated 70 million to goodwill. So we have a remaining impairment loss of how much? Is it 44 million? Yes, 114 minus 70, 44. Now that will be allocated to the other asset. Remember, that is what you have said here. Other assets, based on the net book value. In other terms, we said we allocate that one on pro rata basis. So we allocate the impairment loss based on the carrying amount, based on the net book value. So what we need to do is basically to have the net book value. Net book value is the same with the carrying amount of the two assets. And as per the information we have below paragraph 2, we have two assets there that is landed buildings, land and buildings. Buildings. So the carrying amount for that, is 320. Then below that we have plant and machinery. Plant and machinery. The carrying amount for that is what? Is 110. So we get the total here, which will give us 430. So therefore, the remaining impairment loss will have to be allocated to the two assets using this carrying amount, using this particular carrying amount. So let's start by determining the amount of impairment loss to be allocated to this asset. And that is land and buildings. Land and buildings. And basically the amount of impairment loss to be allocated to land and buildings will be 44 million. The remaining impairment loss, 114 minus 70. And then we multiply that with the carrying amount of land and buildings, which is 320. We divide that with the total, which is basically what? 430. We divide that with the total, which is 430. So that will give us an amount of how much? To the nearest whole number, to the nearest whole number, to the nearest whole number, to the nearest whole number. Yes, to the nearest whole number, that one will be 33 million. Now, we also need to explain how are we going to account for this. Now, remember, this particular impairment loss here, there is something I've forgotten. This impairment loss of 70, this impairment loss, this one will be recognized as an expense. This one will be recognized as an expense. Recognized as what? As an expense, simply because goodwill is carried in the statement of financial position at historical cost. That is as per the information which we have in note number 2, the last sentence. All the other assets other than land and buildings, they are carried at historical cost. So any impairment loss for an asset carried at historical cost is recognized as an expense. So this one is an expense. But now, going back to note number 2, these landed buildings, we are told they were carried at revaluation. They were revalued some time back. And then you are told that the revaluation surplus relating to landed buildings that remained in that revaluation surplus reserve at the end of the year was 65 million. So these particular landed buildings were revalued some time back. And therefore, after revaluation, there is a revaluation reserve for these particular landed buildings, which amount to how much? 65 million. Now, the question is, how do we account for this impairment loss? Do we recognize it as an expense in the income statement? No. So in case an asset is carried at a valued amount, any impairment loss should be charged not in the income statement, but basically that one should be charged in this account. In this account. I'll be able to explain what I was talking about there, the excess. But in this case, we can say that this impairment loss of 33 million is not an expense. But should be debited. Should be debited in the revaluation reserve account. So to debit a revaluation reserve is to reduce. So we are going to reduce this with an amount of 33. So that means that the revaluation reserve after accounting for this will be the 65 minus 33. That one should be 32. Should be what? 32. But let's assume that the impairment loss maybe which you have computed here is maybe something like 70 million. the impairment loss which we have computed, which we have allocated to other buildings, let's assume it is what? It is 70. It is 70. Now, the question arises, how do we account for this? Take into account the revaluation reserve is 65. Now, to account for this amount of 70, so the amount which you are going to debit in this account in the revaluation reserve, the amount to be debited in the revaluation reserve account should not exceed the amount of revaluation reserve. Revaluation reserve is 65. So the amount to be debited in this account will be 65 million. But I hope you can see how much is our how much impairment loss we have allocated to this asset. It is 70. So now, what is the excess? The excess is the amount of impairment loss which exceeds the revaluation reserve. The amount of impairment loss which is in excess of the revaluation reserve. And how much amount is in excess? How much impairment loss is in excess of the revaluation reserve? It is 5 million. Now, that 5 million is what we recognize as an expense in the income statement. That is now what we recognize as an expense in the income statement, 5 million. And that's why you can see here, because now this one is not even more than this, so the full amount is debited in the revaluation reserve. So someone may ask, where do we take the credit? Or which account do we credit? Basically, we credit the asset account. So we credit added buildings. Because remember, in this case, I've said an impairment loss reduces the value of an asset, reduces the value of the asset. So that's basically how we account for that. That's why in that question, Douglas, we are given in note number 2. So that's why we are given note number 2. So that's now you explain how we account for this how we account for this impairment loss of 33. It will be debited in the revaluation reserve, the full amount. The full The full amount. Sasa, yes. And then next we need to determine the amount of impairment loss to be allocated to this other asset, which is plant and machinery. And take into account plant and machinery are carried at the valued, at historical cost. The full amount of impairment loss will be charged will be recognized as an expense in the income statement. So the impairment loss to be allocated to this will be equal to its carrying amount, which is basically 110 all over the total for 30 times the impairment loss to be allocated to the two assets, which we said is 44. This one, 44. So that will give us what? That will give us 11. Yes, 11 million. So 11 million, we can say that this one is an expense. 11 million is to be recognized. As what? As an expense. As an expense in the income in the income statement. Should be recognized as an expense in the income in the income statement, simply because this asset is carried at the valued is carried at the valued amount. Is carried at the valued revalued amount. So basically, this is a very good question on impairment because the examiner tested almost so many concepts here. How we account for the impairment loss whenever we have assets which are carried at the valued amount, which are carried at historical cost, and also how we determine the impairment loss in general. How we compute the net realizable value, how we compute the value in use, and also the allocation of the impairment loss. It was a very good question on impairment loss, or basically on impairment of asset at the IS 36, because the examiner tested so many concepts there. So many concepts there. Yes. So I think that is it. That basically what is required as far as that question is concerned. Now, we also have another question, which was on this, and I don't think we also did it in class. It was in 2021. Let's go to the papers for 2021. I think specifically should be May. Is it May or September? Should be September. September of 2021. September of 2021. Yes, so here I've said no amount which will be recognized as an expense, NK, yeah? No amount to be recognized as an expense in the income statement. Because you can see impairment loss allocated to landed buildings is 33. That one is not in excess, or this one is not more than revaluation reserve. Sasa, but I've said now, I think you have understood. I've said if, for example, it is 70, so the amount which we debit in this account should be 65. The amount we recognize as an expense should be 5. I hope you asked that question before this. I hope you have asked the question before I gave that particular further explanation there. Sasa. Yes, yes. So basically that is it. So let's go to this other question for September 2021. September 2021, specifically question 5, 5C, 4C. 4C is also another good, very good question on impairment. On impairment, September 2021. Yes, I hope you are there. September, question number 4. Question number 4, 4C. Question 4C. So if you're here, is 5, eh? Okay. Huh? Yes, it should be question 5, not 4. It should be question 5. Should be question number 5. It should be question number 5. Okay. So what are we told? Yes. So what are we told as far as that question is concerned? So the question reads, Packer Limited acquired 100% of 𝐎𝐍𝐋𝐈𝐍𝐄 Limited on 1st of January 20, that is 1st of October 2017. 𝐎𝐍𝐋𝐈𝐍𝐄 Limited 𝐎𝐍𝐋𝐈𝐍𝐄 Limited export electronic materials across the world. And then you told us at the date of acquisition, goodwill on of shillings 12 million was calculated. The entire amount of the goodwill has been outstanding since then, because 𝐎𝐍𝐋𝐈𝐍𝐄 Limited recoverable value has remained higher than its carrying amount. For the year which ended 30th of September 2020, however, there was indication that 𝐎𝐍𝐋𝐈𝐍𝐄 Limited may be impaired, and we are told no adjustments to the group financial statements relating to this matter has been made. So we are told Packer Limited acquired a subsidiary, 100% shareholding in 𝐎𝐍𝐋𝐈𝐍𝐄. So this basically 𝐎𝐍𝐋𝐈���𝐄, which is basically a subsidiary to the parent company, we can say is a cash generating unit. Is a cash generating what? Is a cash generating unit. So we are told 𝐎𝐍𝐋𝐈𝐍𝐄 Limited business is divided into two cash generating units, CGUs, the industrial division and the domestic division. When 𝐎𝐍𝐋𝐈𝐍𝐄 Limited was originally acquired, 8 million of the goodwill was attributable to the industrial division and 4 million to the domestic division. The carrying amount of 𝐎𝐍𝐋𝐈𝐍𝐄 Limited CGUs as at 30th of September 2020 were as follows. So we are given two cash generating units, industrial division and the domestic division. And actually we're given the assets in each of the assets, in each of the CGU, that is, we have PP, inventory, receivable, cash, and payables. And then we have the total carrying amount. And then you're told in the other paragraph, in relation to the recoverable values of the division, it has not been possible to establish the net selling price for either division, but an estimate has been received of the future cash flows for each of the CGU for the next 5 financial years. These were as follows. So we are given the information about the two divisions. Actually, the cash flows, the future cash flows of the two divisions from 2021 to 2025. We have operating cash, interest, and then we have tax. So then we have a domestic division, operating cash, interest, taxation. Then in the additional information, we are told the industrial division would be sold at the end of 2025 at for an estimated shilling 6 million. Number two, we are told the domestic division would be held indefinitely, generating cash flows of 1.5 per annum in perpetuity. And number three, we are told the pre-tax cost of capital of 𝐎𝐍𝐶 Limited is 8% per annum, and the rate of tax is 30% per annum. So we are told the foreign discount factors are relevant from year 1 basically to year 5. We are given the present value interest factors. What are we required to do? We are required to calculate the impairment in conformity with IAS 36, impairment of assets that would be recognized in the group financial statement for the year which ended 30th September 2022 in relation to 𝐎𝐍𝐶 Limited. So basically, you're told 𝐎𝐍𝐶 here has got two cash generating units, two CGU. So therefore, what we're going to do, we will determine the impairment loss for individual CGU. So we need to compute the impairment loss. The impairment loss of the cash generating units. The cash generating units for which year? This is for the year which ended 30th September. That is September 2022. That is of September 2022. That is of September 2022. So we just need to recall here that impairment loss, this one is equal to the carrying amount minus the recoverable amount. Also, take into account we have two divisions, the industrial division and the domestic division. We will start by determining the impairment loss of the first division, that is the industrial division. Industrial division. Remember, division I've said is a CGU. This is basically a group of assets which generate cash flow as a group. So now if we go back to the information we have in paragraph 1, not paragraph 1, I think paragraph 3, or actually paragraph 4, we are told the carrying amount of 𝐎𝐍𝐶 Limited cash generating units were as follows. So we are given 13 for the first division, that is the industrial division. That one is given as 13,870. But there is something which is not basically included here because we are told 𝐎𝐍𝐶 Limited is a subsidiary. At the date it was acquired, there was a goodwill. And then I think in relation to which information, in relation to paragraph 3 of that question, can you go to paragraph 1, paragraph 2, paragraph 3? Paragraph 3. In paragraph 3, we are told when 𝐎𝐍𝐶 Limited was originally acquired, 8 million of the goodwill was attributable to industrial division and 4 million to the domestic. So from those particular values, those carrying amounts which are given there, I hope you can see goodwill has not been included there because you're given PP, inventory receivable, cash, and payable. So therefore, to get the carrying amount for these cash generating units, we will take the value which are given, which is 13,870, and then we add a goodwill attributable to this CGU. The goodwill attributable to this cash generating unit, we are told is 8 million. And basically that will give us what? That will give us 21,870 million. 870 what? Million. That should be the correct carrying amount. So having that, we need to move and we determine the recoverable amount. So the recoverable amount, this one would be higher of two values, the net traceable value or the fair value less cost to do what? Less cost to sell. There is some information which are given on this, specifically below where we are given the carrying amount. Below where we are given the carrying amount, we are told in relation to the recoverable amount of the division, it has not been possible to establish the net selling price for either division. It is not possible to establish the net selling price. In this case, when we talk about the net selling price is the fair value less cost to sell, because fair value less cost to sell is the net selling price. It's the amount at which you can sell an asset at minus the cost you are going to incur in selling that asset. So therefore, there is no information which is available to this company to determine this. So therefore, this one will not be applicable in our case because there is no any information to determine that. So then, Roman 2, we determine the value in use. The value in use, this one is equal to the present value of what? Of cash flows. The present value of what? Of cash flows. So do we have the cash flows of this division? Yes. So, and from the information which you're given here, you can see we are given operating cash, interest, taxation. So basically below what you're given below taxation, that should be profit. Let me ask here, and that is also a concept you apply in FM. Whenever we are evaluating a project, do we use the profits, the future profit, the expected profits, or do we use the cash flows? What do we use whenever we are evaluating a project? Wanga tunatumia cash flows of the project, ama wanga tunatumia the profits of the project? What do we use? In this case, we use cash flows. We use what? Cash flows. So from the information which are given here, we are going to use the operating cash flows, not the profit, which is below tax. We are going to use what? We are going to use those particular cash flows. So in our case, basically, we need to have year 1, 2021, all the way to year 2025. But also in the additional information, we have terminal cash flows. So we need to discount those cash flows. So basically, we're going to have a column for years 2021 all the way to 2025. 2024. And I think we also have a terminal cash flow. You're going to capture that there. So how much is the cash flow here? We have cash flows. So here we have 15. We have 15. We have 1,000. Okay, we have 1,000. And also we have what? We have 1,000 like that. Then I think we also have a terminal cash flow. Remember, these are the annual cash flows. If we go to the information we have, I think in note number 1, additional information number 1, you're told the industrial division, this division, could be sold at the end of 2025 for an estimated shillings 6 million. Now that is basically what we find as the terminal cash flow. I hope you can be able to recall what is terminal cash flow. The cash flow which is expected to be generated at the end of the project life, 2025, there will be still cash flow of 5 million. You may decide to combine that here. You have 7 million, or you can just put it here because this is basically year 5. No problem. Whenever you're discounting this, we will use the same present value interest factor for year 5. Sasa, yes, that's why I'm saying you can combine it. Here you have 7,000, or you just put it separately. So then we multiply this with the present value interest factor. Remember, we have said that we do what? We discount this particular cash flows using something called the pre-tax cost of capital, the pre-tax COC, the pre-tax cost of capital. So that one is in note number 3. We are told the pre-tax cost of capital of 𝐎𝐍 Limited is 8%, and the tax rate is 30%. Automatically, the examiner was giving you tax rate. You may decide to compute the cost of capital after tax, but we use the pre-tax COC, the pre-tax cost of capital, which is basically 8%. Now, in our case, do we need to compute these particular values? No, we need to use the values which are given in note number 4. We are given the present value interest factors. For example, if you compute for year 1, 1.08 raised to power -1, you should get a value which is almost, actually figure which is given in note number 4, but I think our figures are given to 3 decimal places. So we work with those figures the way they are given. Maybe you can just confirm, are you getting that value there? Are you getting that 1.08 raised to power negative 1? Yes. So therefore, what we do, we work with those values given in note number 4, 0.926, 0.857, 0.794, 0.735, 0.681, and still this also year 5, 0.681. We're going to use the same discount, the discount factor, or basically the same present value interest factor. And then we multiply those values here. So can you multiply all those values and then you add, you give me the final value here. You add and then you give me the final value there. Multiply that, and basically you record those particular values here to the nearest whole number, and then add everything here. You give me the total. Okay, Douglas is very fast here. I think we already have the final figure from Douglas. So the nearest whole number, maybe you can just someone else to confirm whether that is the value you're getting. Someone to confirm whether you're getting the same value there. Are you getting the same value? You're getting the same value. You're getting the same value, Yes, so that is confirmed by Elizabeth and also Mary. Okay, yes, so that is it. And what we have here is basically the value in use, but yes, is the value in use. So what we need to do is we move and basically determine the recoverable amount. So the recoverable amount in this case automatically should be the head of these two values. And remember, you don't have that. So automatically this will be our recoverable amount, 89.71. 89.71. So what we need to do is to determine whether this CGU is impaired, whether our CGU is impaired basically by comparing the carrying amount, the recoverable amount with the carrying amount. We check whether this one is less than carrying amount. Carrying amount is this one. Is are these figures in million of shillings? No, they're not in million of shillings. They are not in million of shillings. They are in thousand of shillings. Yes. So this is basically the carrying amount, 21,870. Recoverable amount is 89.71. So automatically this one is less than the carrying what amount. So meaning that this CGU is what is impaired. So if it is impaired, we basically move and we compute what? We compute the impairment loss. So the impairment loss here will be equal to, we apply our formula here, carrying amount, this one, 21,870 minus the recoverable amount, which is this one, and that is 89.71. 89.71. So I'm told the impairment loss here will be shillings 12 and 9, and maybe you can write that in full because our values, remember, are in thousand of shillings. So that is the impairment loss. Are we required to do the allocation here? No, we are not required to do any allocation. So what we basically need to do is we move and basically we do the same for the other division, for the other CGU, domestic division. So we will start by getting the carrying amount, carrying amount for this division. So carrying amount is what we have below paragraph 1. Not paragraph 1 actually, paragraph 3 or paragraph 4, which is 69.75. 69.75. And then to this, we will also add the value for goodwill. Remember, the value for goodwill is not included here. So the goodwill attributable to this division, as per paragraph 3 of the question, is 4 million. Is 4 million. So this will give us 10,975. That is the carrying what? The carrying amount. Having that, we move and basically we determine the recoverable amount. The recoverable amount is the higher. of two values. The R of number one, the net traceable value, or basically the fair value, less cost to sell. And basically this one will not be applicable because we are told the information which is available, or actually as per the information, or basically the company is not in a position to determine the net selling price. So the company is not able to determine this. So we take that, or number two, the value in what? In use. So the value in use automatically, this one will be the present value of the cash flows. And we have those particular cash flows just above the additional information. We will do the same. We basically have our years here: 2021, 2022, 2023, 2024, and basically 2025. So we have the cash flows. We have the cash flows. And remember, in this case, we have said we use the operating cash flows, not the profit. So we have 2000, 2000, 2000, 2000. And then we have 18, 18, 1850, and then 1850. And then I think we also have terminal cash flows. As per the information you have in note number 2, we are told the domestic division would be held indefinitely, generating cash flows of 1.5 million per annum in perpetuity. So basically, from 2025 here, we are told this asset will be held to perpetuity. Will be held to perpetuity. To perpetuity. I think that basically the symbol which you use, mostly these are concept you do in a firm, generating cash flow of what? Generating cash flow what? Of what? Of 1500, 1500. Now remember, in this case, for this cash flow, because it is generated in perpetuity. So what do we do as far as that cash flow is concerned? For us to be able to discount it, the cash flow generated in perpetuity, there is something we do in relation to that. That is a concept you do in FM. What do we do to that amount? Any cash flow in perpetuity, we divide that with something so that we can be able to discount it. Yes, so we basically divide this with the discount rate, with the discount rate, or basically the cost of capital, the cost of capital, the cost of capital, the cost of capital. So the cost of capital in our case is what? Is 8%. Is it what? 8%, 8%, 8%. So we divide this with what? I think we maybe can just have it here. We divide that with what? I hope it is 8% like that. 8% like that. And that will give us what? That will give us what? After dividing that with 8%, remember, you take that as 0.08. 0.08. 0.08, yes. So that basically will give us, 18,750. So even before you discount that particular cash flow, you take the cash flow in perpetuity, divide that with the rate. Divide that with what? With the rate. Sasa, yes. And then we do what? We discount this. We multiply that with the present value interest factor at the rate of 8%. So those present value interest factors, the same, 0.926, 0.857, 0.794, 0.735, 0.681, and the same case because this is also year 5, like that. Sasa, yes. So we then get the present values. the present values, you multiply all these, and then you give me the total here. You give me the total down there. Yes, I think the computation is the same. The only difference was in relation to this cash flow in perpetuity. Cash flow in perpetuity, cash flow in perpetuity. You needed to apply that concept, those concepts you cover in FM, because those are concepts which are covered in FM in relation to discounting, how we discount cash flow in perpetuity. Yes, so add those, get to those particular present values, you give me the final values here. I'm told it will be 2384. $23.84. I hope that is what you're getting. Yes, that is confirmed by Elizabeth. So having that, basically, we have now the recoverable amount. The recoverable amount basically should be the higher of this and that. Automatically, we don't have net realizable value. Our recoverable amount will be 2384. So we determine whether this CGU is impaired or not by comparing the two values, carrying a recoverable amount and the carrying amount. We check whether this one is less than this. Carrying amount is this one, 10,975. Recoverable amount is what? Is 2384. Is this one less than that? Than the carrying amount? Is it less? Recoverable amount, is it less than carrying amount? No, it is not less. It is not. It is not less. It is not less. So what do we conclude here? What do we conclude? We conclude that no impairment loss will be recognized simply because the recoverable amount is not less than carrying amount. So we say no impairment loss will be recognized. No impairment loss. No impairment loss to be recognized. To be recognized since recoverable amount is not less than who? Than the carrying amount. Is not less than the carrying what? Is not less than the carrying amount. Is not less than the carrying what? Amount. Yes. I think that is it. That basically what was required as far as that question here is concerned. A very, very good question on what? A very good question on what? On impairment of asset. On impairment of what? Of asset. And I think with those two questions which you have done, the two questions we did in class, I think you can then be able to comfortably handle any question coming from this. Remember also, we did something in relation to 𝐻𝐿 21, how to determine impairment loss of assets, or basically how to determine the impairment loss of something we refer to as the non-cash generating assets. The non-cash generating what? Asset. And I think we say that this is a very, very simple area because it is like an extension of what you have done here, only that here we are dealing with the non-cash generating assets. And therefore, the only difference between what we have done here and 𝐻𝐿 21, we say that at 𝐻𝐿 21, this value in use, this one is not the present value of the cash flows because we said and cash generating asset, this asset do not generate cash flows. And therefore, here we looked on three methods under 𝐻𝐿 21, which can be used by a public sector entity to determine the value in use. To determine the value in use, the depreciated replacement cost, the restoration cost approach, and the service unit approach. I think that is an area which is not that complex. And because I think we did all questions in relation to that, yes, all we do this, I think we can, let me get some two questions on this because I can see we don't have a lot of time. Once we come back after the break, maybe do like two questions on this, and then we wind up with that area. Sasa, yes. So maybe we can just take a short break of 10 minutes, and then we come back after 10 minutes. We look on maybe a question on on this. Sasa, yes. So we just take a short break of 10 minutes. We come back exactly at 9, not 9, rather 7:38. 7:38. Yes. So see you after that short break. Let's proceed. I hope you're back. I hope you're back. I hope you're back. So let's continue. There are some few questions I've shared from you here, from the past papers. I want us to look on them. These are questions regarding the computation of impairment loss of non-cash generating assets, and also in accordance with the 𝐼𝐍 21. 𝐼𝐍 21. 𝐼𝐍 21. So maybe you can start with the first question here. So this is a question, I think, back in 2012 there. So the question for Mashabani. So I've shared that the question in the class WhatsApp group. There's a screenshot of some questions from some time back. So we start with that one for Mashabani. We are told that is Mashinani. So we are told Mashinani City Council. Confirm, please confirm. City Council constructed a 20-story office building for use by the council at a cost of 800 million. This building came into use on 1st January 1986, and it was Zido, are you there? Stephen, are you there? Sam, are you there? Martin, are you there? Mother, are you there? Doris, Anna, are you there? Lydian, do you have the question with you? Perfect. Okay. So what are we told as far as this particular question here is concerned? So this is a very good question on conversion of partnership business into a limited liability company. And the question is, that is specifically part B. So we are told John, Kelvin, and Renette have been into partnership for several years, sharing profit and losses in the ratio of 5:3:2 respectively, after allowing for a 10% interest on fixed capital balances of the partners. No salaries or commissions were to be paid to the partners. The trial balance as at 30th of June 2024, extracted from the financial records of the business, revealed the following. So we're given the trial balance there. One, we have the profit for the year. We have the inventory as at 30th of June, of 2024. Account receivables, account payable, bank overdraft, property at carrying amount. Remember, I've said carrying amount is the same with the net book value. That is what you need to remember. We have the motor vehicle at carrying amount, office equipment at carrying amount, equity investment at fair value. We have the partners capital account, partners current account drawings, and then we have the loan from Kelvin. We have additional information. Number one, you're told actually in the first paragraph there, we are told the partnership was converted into a limited liability company, JKL Limited, with effect from 1st July 2024 under the following terms. Number one, you're told the purchase consideration of the business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of shillings 10 per value in full satisfaction of the purchase consideration. So the new company was to pay a purchase consideration of 150 million. This was to be paid by the new company issuing its own shares, issuing 15 million ordinary shares, each share having a par value of 10. Number two, we are told equity investment were taken over by the partners at the fair value of 18 million and allocated to the partners in their profit and loss sharing ratio. Equity investment is basically investment in shares. This one was not taken over by the new company, but rather this one was taken over by partners. So therefore, this is an asset which was taken over by partners. And then from there, we are told number three, the loan from partner Kelvin was transferred to the new company at the carrying amount. Number four, other assets and liabilities of the partnership were taken over by the new company at the following values at the following what values. So we are given the assets which were taken over, the assets and liabilities which were taken over by the new company. We have property, we have plant and machinery, motor vehicle, office equipment, and we are given the value at which we were taken over it. Then we have inventory which was taken over at the book value less 15%. Account receivable was taken over at book value less 10%. Current liabilities were taken over at the book value. Finally, number 5, we are told the new company issued 2 million ordinary shares of shillings 10 at each at par value. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over with the balance used as working capital. So what are we required to do here? We are required to prepare the foreign ledger account to close off the books of account of the partnership. Number 1, the realization account. Number 2, the partner's capital account. And number 3, the partner's capital account. So actually, those are the accounts which are prepared to close off the books of account of the partnership. Then Roman 4, we are required to prepare the opening statement of financial position of the new company called JKL Limited on 1st of July 2024. So what we are going to do first of all is to cross off the books of account of the partnership by preparing the first 3 accounts: realization, partner's capital account, and then the partner's capital account. But before we do that, if you go back to the trial balance which you're given, can we go back to the trial balance? The first item in that trial balance which you're given is the profit for the year. Now, let me ask here, what happens to the profit of the partnership? If, for example, we are partners in a partnership business and our business has reported a profit, what happens to that profit which is reported by a partnership business? Who can tell us? What happens to the profit which is reported by partnership business? Where does that profit go? Where does that profit go? Is it retained as a reserve? Is it supposed to be shared? Yes, automatically, once a partnership business reports a profit, that profit is supposed to be shared among partners. We know from the definition of a partnership business is an association of partners who carries on a business with an objective of making and sharing profit. So any profit which is reported by the partnership business is supposed to be shared among who? Partners. How do we share that profit? We share that profit from what you did in the topic of partnership in financial accounting. We share out that profit by preparing something called the appropriation account. And therefore, even before we cross off the books of account of the partnership, so the first thing we need to do is to share out that profit among the partners. We are going to share out that profit by preparing something called the partners, the appropriation words, the appropriation account. So let's first of all, we prepare that account, which is called the appropriation account. So why are we preparing this account? Is to share out that profit. Appropriation what? Appropriation account. Appropriation account, and I hope you can be able to recall the format for this account, the format for appropriation account. Okay, so the figures which are given here, they are in million of shillings. So basically here, we should have 2 columns. 2 columns like that. So in preparing this particular account here, we always start with the profit for the year. Profit for the year. I hope you can be able to see that far ahead. We always start with the profit for the year. And then to this profit, we usually add the interest on drawings. We usually add the interest on drawings. The interest on what? The interest on drawings. After adding the interest on drawings which is charged to the partners, we then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit. The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check Were the partners charged any interest? When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that one should be added to the amount to be shared. Sasa? Yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Renette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2, after allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the loan from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what, all commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? And Renette. So, and we are told that this one would be 10%. This one would be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Renette is 18,800. 18,800. 10% of that will be 18 what? 18,80. 18 what? 18,80. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa. Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna, maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So in our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business. So then from there, the other appropriations the partners may be entitled to, will be entitled to, is what? Is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, you're going to have a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So you have 42,800 minus 43,70 minus 28,50 minus 18,80. So the amount to be shared as profit, I'm getting 33,700. Now that profit would be shared among our three partners, John, Kelvin, and who? And Renette. So they will share a profit of 33,700, 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3 is to 2. 5:3 is to 2. That is for John, Kelvin, and what? And Renette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Or the losses, Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Also? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and Renette 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16,850. Kelvin, we take 33,700 times 3 divided by 10. And basically that will give us 10,110. And then the other partner net, that is 3,700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0, because that amount of profit has been shared among who? Has been shared among partners. Now, once we are through with that, then we can proceed and basically cross off the book of account of who? Of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. So what we just need to remember here is what do we record in this particular account, the realization account. What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is a ledger account. Is a ledger account. Partners current account is basically a ledger account. Ledger account means that this account will be having a debit and the credit side. The debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column, and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here, and then column for the 3 partners. We have the first partner, who is John. We have Kelvin, and we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column, and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column, we have John, we have Kelvin, we have Lynette. This, remember, is the credit side. And also the figures are in what? In thousands of shillings, like that. In thousands of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to cross all those accounts. You cross off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information with number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partner's capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities. All those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance. Note the value which is given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa? Yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So the value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 25,240. So, and then from there, we have equity investment. Equity investment, this one, was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember, this is an asset. This is what? An asset. So therefore, this is a debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need, first of all, to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we have crediting this account, which is called equity investment, with 10,000, then we will debit this account. We will debit the partner's capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference, which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually, this difference, we can refer to it as a revaluation gain, because when these equity investments were taken over, they were revalued from 10 million to 18. So this is a revaluation gain. Now, this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment, which is 8. Then we need to debit this account with 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and all sharing ratio. The profit and all sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see there is nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partner's capital account. Now, the partner's capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the trial balance. They are on the credit side. So what do? We record those balances here, and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800, 18,800, 18,800, 18,800, 18,800, 18,800. Sasa 18,800. Yes. So then from there, below that, we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For John is 14,790. For Kevin is 12,960. 960, and basically for Renette is what? 9850. 98 what? 9850. 98 what? 50. 9850. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in this account. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in this account. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here. But I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here. And then in this account on the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of a profit. The share of what? The share of profit, like that. Sasa? Yes, Doris, what you have said is that the investment which were shared by partners, they are shared at a value of 18 million. At a value of 18 million. That's what you are told in note number 4. We have shared out this investment at a value of 18 million. That's what you have said. That's why you have said we debit the partner's capital account at 18 million. So if you add all that, should give us 18 million. Yes. Now, what I want us to do before we move, we go back to the trial balance, I want us to record these items because we have recorded drawings. We have recorded drawings. Before you finalize, okay, I think let's first of all finalize with what we have in the trial balance. Below the drawings, what do we have below that? The loan from Kelvin. And there is some information which are given in relation to that. Note number 3. Additional information number 3, we are told the loan from Kelvin was transferred to the new company at its carrying amount. So loan from Kelvin is a liability. So that loan was transferred to the new company. So that is basically a liability. That is a liability which was taken over by the new company. So the loan from Kelvin. So, and I hope you can remember liabilities taken over by the new company, they should be credited in this account. So how much is the loan from Kelvin? The last item in the trial balance. The last item in the trial balance is 91. So that is a liability which was taken over by the new what? By the new company. So I think you can see we are done with crossing all those balances, all those particular accounts which are balances at the end of the year. Now what is remaining is for us now to post these items here. So these appropriations. We have said in case we had interest on drawings, that one should be debited here. Salaries and commission to partners should be credited here. Then we have interest on capital should be credited here. So let's credit interest on capital here. So for John is 43.70. For Kelvin is 28.50. And basically for Inet is 18.80. Then we also have the share of profit, this one. So John is 16.850. Kelvin is 10.110. And Renette is 67 what? 40. 67 what? 40. So we are basically done with posting those items there. Now what is the remaining is basically for us to balance this account. Okay, before we do that, there is something we are almost forgetting. Can we record the purchase consideration which is given in the last note? The last note, note number 5. Sorry, not note number 5, note number 1. In note number 1, we are told the purchase consideration on a business purchase was agreed at 150 million. Where do we record the purchase consideration which was agreed? The purchase consideration record in the business purchase account should be credited. The purchase consideration which was agreed. And that is 150 what? Million. 150 million. I think basically we are done. So what is the remaining is for us to balance this particular what? Account. Now the first account which we have to balance is this one, the partner's current account. Partner's current account. Now this basically account shows the amount of money which the partners were entitled to receive from the partnership business. So the balancing figure from this account should be crossed off, should be transferred to this account. So that by the end of the day, we know the amount of money which each partner was entitled to receive. So the first account which we balance is this account here. Is this account here. So let's start by balancing this account here. And I've said the balancing figure will be crossed off to which account? Will be crossed off to the partner's capital account. So how do we balance this account? We balance the current account for individual partners. So we will start with John. So we compare what we have on the debit and basically what we have on the credit. So I think on the debit side, we don't have any amount. What about on the credit side? In the current account of John, we have 14,790 plus 4370 plus 16,850. That's what we have on the credit side. So we take what we have on the credit side minus what we have on the debit side. On the debit side, we have 0. So we should take 36,010 minus 0. So the balancing figure will be on this side. Do we record it here as a balance carried out? No. So that balance I've said we transfer it to this account. So that balancing figure, we transfer it to the capital account, which is 36 what? 010. 36,010. Oh, yes. Thank you, Otito. Morimo is almost forgetting to record drawings. Thank you. Yes, we have drawings. We didn't record the drawings. Sorry for that. So the drawings we have 43, 70, 40, 20, and what? And 29 what? 10. Thank you for that. Yes. So it basically means that we need, before we get this, we need to raise the drawings here. We need to raise 43, 70. 43, 70. And the amount which we get here will be 31, 6 what? 40. Now we cross off this particular amount. We cross off this particular amount to which account? To this account. And basically we follow the rule of double entry. You can see this account is credited. Sorry, is debited, sorry. Then to complete the double entry, we need to credit this account. We credit this account. So we will say that there is an amount coming from the partner's current what? Current account. The amount from the current account of John is this one, 31 what? 640. So we do the same for the other partners. So Kelvin, we add what you have on the credit. Whatever you have on the credit side is what is more. 12,960 plus 2850 plus 10,110. That is what we have on the credit minus these ones. Minus this value here, 4020. And that will give us 21,900. We debited here, we credited here to complete the double entry. So we do the same for net. So for net, we have 9850 plus 1880 plus 6740 minus what you have on the debit, 2910. And basically I'm getting 15,560. 15,560. Are you getting those values? Is that what you're getting? Yes. So basically in our case, we are done with this account. This is now what was required there. That is what was required in the partner's what? In the partner's current account. Now, then next, what we need to do is basically we balance this account. Now, what we have said is that this account will be having a balancing figure, and the balancing figure in this account can either be on this side. If it is on that side, it is a gain on realization, and that has to be shared among partners using their profit and loss sharing ratio. If the balancing figure is on this side, is a loss on realization. Equally, it will be shared among partners and taken to the partner's capital account. If the balancing figure is on this side, it is a gain on realization. Yes, can we balance this account to see whether we have a gain or what? We have a gain or basically what? A loss. So let's add what you have on the credit, that is 2,700 plus 68 plus 8,000 plus 9,100 plus 150,000. So basically I'm getting 206,600. That is what I'm getting on the credit. What about on the debit? And you confirm whether you're getting the sum, that value on the credit. On the debit, we have 28,400 plus 23,800 plus 72,950 plus 37,730 plus 10,580 plus 25,240. So on the debit side, I'm getting 198,700 on the debit, and that is what I have on the credit. Are you getting those values? Are you getting those values? Yes, so that is confirmed. So meaning that the side which is more is on that is this side, the credit side. So meaning, take into account this side is more, the balancing figure will be on the debit side. On the debit what? Side. And actually the balancing figure should be the difference between those two values. 198,700 minus 206,600. So the balancing figure will be 79. 79, that is a gain on realization. So that gain on realization, we said it will be shared among partners using their profit and loss sharing ratio. That will be shared between John, Kelvin, and Renette. And who? And Renette. We are going to share out that using their profit and loss sharing ratio, which is this one. So the share of John will be 5/10, which will be 39.50. What about the other partner? The other partner, that is Renette, Kelvin, will get a share of 3/10, which is 23.70. And the other partner will get 790 times 2. And basically that is 15 what? 15.80. Is that what you're getting? A gain on realization. Gain on realization, 39.50, 23.70, and 15.80. 15.80. Confirm whether that is what you're getting. Is that what you're getting? 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 Steven, Zido, is that what you're getting? Otito? Sam, is that what you're getting? Doris, Anna, are you getting that value? Are you getting that? Yes. So basically, after doing count, finally, what we need to do is we balance this account. We balance this account, we balance the partner's capital account, and basically the balancing figure in this account, which always is on this side, which always is on the debit side, it represents the amount of money to be paid to each partner. So the balancing figure on this side represents the amount of money to be paid to each partner. Remember, we say that the partners here have accepted to sell their business to the company. They must be paid something called purchase consideration. So what we balance this account. The balancing figure which we get here is the amount to be paid to each partner. And once we add the total amount to be paid to our three partners, the amount to be paid to John, Kelvin, and Renette, that one always has to be equal to this. Has to be equal to the purchase what? Consideration. Can we do that? So automatically we take what we have on the credit minus what we have on the debit. We start with John. We take 43,700 plus 31,640 plus 39,50 minus what we have here, 9,000. That will give us 70,290. So that is the purchase consideration which John will receive. Out of this 150, John will be paid 70,290. What about Kelvin? We add what we have on the credit, 28,500 plus 21,900 plus 23,70 minus what we have here, 54. That will give us 47,370. So out of this 150, that is basically the amount Kevin will get. What about the net? 18,800 plus 15,560 plus 1850. That is 1580 minus 36. And basically I'm getting 32,340. 32,340. Is that what you're getting? The amount to be paid to each of the partner. The amount to be paid to each of the partner. And basically we are saying if we add this, and that should give us the amount of 150. So can we confirm? Because that is basically how we should confirm. So we take 70 to 90 plus 47, 370 plus 32, 340. Yes, you can see that basically give us that. That give us what? That basically that's how you confirm you are correct. And equally that basically what was required in that particular what? In that particular account. So what we have done basically, we have crossed off the books of account of who? Of the partnership. Of what? The partnership. Sasa? Yes. So that's basically how we cross off the books of account of the partnership. Now, there are still other questions. Like I think there was a question in 2021, which is basically similar to this one, whereby the examiner will just require you to prepare the realization account and the partner's capital account. You will not be required to prepare this account. Are we together? If you happen to come across such a question, you are not required to prepare this account. Now, all these items you are recording here, you record them in this account. Are we together? If you're not required to prepare this account, you're just required to prepare realization. And this account, all these items, you record them here. So for example, these balances, in the opening balances here, you'll come here after recording this one, you'll come and record this opening. You'll not refer to it as a balance carried down because you already have a balance carried down here. You'll say that this is the balance from the current what? From the partner's current account. You record these balances here, all of them, and then all these items, you credit them here. All these items, you do what? You debit them here. So in case the examiner has not required you to prepare this, all these items, you record them here. I think there is a video I'll be able to share with you of a question, I think in 2019 or 2021, which is basically similar to this, but the examiner was not requiring candidates to prepare this account. This one, the candidates were required to prepare this and this. So all these items, you record them here. Sasa? Yes. Now, having that, I want us to finish by preparing the statement of financial position of the new company. That's what we required in Roman 4. But before we prepare that that account. Is that the case? Yes. So let's basically finalize by preparing the statement of financial position. Preparing the statement of financial position, but there is an account we need to prepare. Remember what we have said. When opening the books of account of the partnership of the new company, we have to prepare an account called the business purchase account to determine whether we have goodwill or basically capital reserve. But let's first of all, we prepare the statement of financial position. We will be able to, I will show you how to prepare that. So we prepare what is required in Roman 4, opening statement of financial position of the new company, JKL Limited, as at which date? We're given that date. We are given that date. My Modimo's question is disappearing here. The date is as at first of what? As at first of my question is disappearing. Yes, it's at 1st of July 2024. This is basically immediately after the new company took over the business of who? Took over the business of the partnership. Took over the business of who? Of the partnership. Yes. So here, what you're going to record, the assets that are the assets and the liabilities which were taken over by the company from the partnership. And when recording the assets here, we record them at the fair value. The assets were taken over at the fair values given in note number 4. So what we do, we record those assets here at their fair value. So we have the non-current assets. So let's record the asset from note number 4. Actually, here we have so many free marks because you just need to pick those assets we have in note number 4. So the first asset which was taken over is basically property, and we record that asset here at the fair value, not the carrying amount we have in the trial balance, the fair value. So this one is 74,560. So then below that we have plant and machinery. Plant and machinery was taken over at 35,200. 35,200. Then we have motor vehicle. Motor vehicles, which were taken over at a value of 95,20. Then we have office equipment. Office equipment, you can see all these are free marks, which was taken over at 23. 6 what? 23,660. 23,660. Then inventory, account receivables, those are items of current asset. But what we need to do here, we are going to leave some space because there is an account we need to prepare that is called the business purchase account. We determine whether we have a goodwill or the asset and abilities of partnership was taken over by the new company as a goodwill or capital reserve. So leave some space here. In case we have a goodwill, we are going to record it there. And then from there, we proceed and basically record the current what? The current assets. Now, the current asset, we start by recording inventory, which is given in note number 4. We are told the inventory was taken over at the book value less 15%. In other terms, we can say the inventory was taken over at a value equal to 85% of the book value. Can we say so? Can we say that the inventory was taken over at a value equal to 85% of the book value? Yes. What is the book value? The book value is what we have in the trial balance. And basically those inventory are the second item in the trial balance. The book value is 28,400. 28,400. But in this case, there is also some information which we have in note number 5. Let's go to note number 5. We are told the new company issued 2 million ordinary shares of sharing 10 each at par value. So this new company issued shares, 2 million shares, shillings 10 each. And then you're told the proceeds. The proceeds is the amount which was received from the issue of shares was utilized to settle the bank overdraft and the loan which was taken over, with the balance being used as working capital. There are some instances whereby you may be told that maybe part of that money which was raised was used in terms of buying additional inventory. So in case maybe there was additional inventory which was bought, we should add that here, but none. So let's get 85% of 28,400, and basically that will be 24, 140. So then we go back to note number 4. Below inventory, the other asset which was taken over is the account receivable. Account receivable, which was taken over at book value less than 10%. In other terms, we can say that this one was taken at a fair value of 90% of the book value. 90% of the book what value? The book value is, we have it in the trial balance, the third item in the trial balance up there, which is 23,800. 23,800. So we get 90% of that times 23,800, and basically that will give us 21 for what? 420 years. So then in note number 4, I think the other information we're given here is about the liabilities. About the liabilities. But it is also important for you to note that this partnership business had an overdraft. And then what you're told in note number 5 is that this company issued some shares, it raised some cash. That overdraft from the partnership was settled. Automatically, there is some amount of money which remains in the bank. So what we need to do here, we need to prepare a bank account, and we determine how much bank balance, how much amount of money was left or remained in the bank account. from the amount which was raised from the issue of shares, and after the payment of the two liabilities, after the payment of the overdraft and the loan, how much amount was left? How much amount remained in the bank? So we can only be able to do that by preparing a bank account. We can only be able to do that by preparing the bank account. What do we record in this account? In this account, in the bank account, you're going to record the amount of money which was raised through the issue of shares as per the information we have in note number 5. We are told the new company issued 2 million ordinary shares of shillings 10 each at par value. So once the company issues shares and the company receives some cash, that cash should be debited in the bank account and then credited in the share capital. In our case, we're interested in money received. 2 million times 10. The amount received is 20,000. Remember, all our figures are in thousands of shillings. Then in note number 5, we are told this amount of money, which is 20 million, that is paragraph sentence 2 of note number 5. The proceeds from the issue were utilized to settle the bank overdraft and the loan which was taken over from the partnership, with the balance being used as the working capital. So there are 2 items which were paid. Those 2 items which were paid should be credited here. The first one which was paid is the loan, and the other one is the bank overdraft. And basically, the loan which was taken over from the partnership is the last item in the trial balance. In the trial balance which we have there, the loan which was taken over from the partnership had a value of 91. I hope you can see that in the trial balance, the last item. And then the bank loan, the bank overdraft, sorry, is up there where we have net profit, inventory in the trial balance still, account receivable, account payable, we have bank overdraft of 68. So those are the 2 items which were paid. So automatically the balance that we are going to account for it here as a current asset. So let's just get the balancing figure. So we just take 20,000 minus the 2 items which were paid, 91 and 68. So that will give us what? That will give us 41. So this is the amount of money which was left in the bank account. In the bank account, that one will appear here as a current asset. As a current what? As a current asset. Anything which is remaining here? No. But automatically we can't get the total because we need to compute to determine whether we have goodwill. And then that is the only time we will come back and we get what? The total assets. So before we do that, then we move. So remember, there is something we need to compute there. I'll show you how we compute that. We proceed and record equity. Remember, this is now a company. Now, this company here will be having a share capital. So the share capital of this company will be equal to what? Number 1, we have these shares which were issued for cash as per note number 5. The shares issued for cash had a value of 20,000. Number 2, if you go to the information you have in note number 1, we are told the purchase consideration on business purchase was agreed at 150 million, and the new company issued 15 million ordinary shares of shillings 10 par value each in full satisfaction of the purchase consideration. Now, this company, we are told, also issued 15 million shares, each at a par value of 10, and these shares were issued to the partners to pay the purchase consideration. Remember, the 3 partners were to be paid 150 million. They were paid this by being issued with the shares of the new company. So this company issued some shares in cash, and then there were these shares which were issued to the partners to pay the purchase consideration. So 150 million plus 20, and that will give us a share capital of 170 million. So that is the share capital of this company. Then after preparing the business purchase account, we need to determine whether we have a capital reserve. I've said after preparing the business purchase account, we can have either goodwill or capital reserve. We will see. And then we will get what? The total equity. The total equity. Then from there, we need to move and record the non-current what? Liabilities. The non-current liabilities, in this case, do we have any non-current liability? Any non-current liability? Is our company having any non-current liability? Automatically, no, because
Santa class is to ensure we are recording. So now we have missed something, but no problem. So we are saying So maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value. When we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money. Introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal. 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity? No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management, and that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Eh? Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here, N. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before we continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shillings 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. Three 322,080. 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year. At the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what gets us for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus R power n minus 1 over R times 1 plus R. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the beginning, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711, $519. Now, the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. And this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Oh, okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equals to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor r percent power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there at 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what we are supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value No, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration, present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay For that project, if the required rate of return is 10%. So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, present value of annuity is equals to the annuity times 1 minus 1 plus R power N over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Therefore, present value of annuity is equals to annuity times present value interest factor annuity R percent power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% you up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather have a good night. Have a good night. check whether start a class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here, shillings 1 million, and here we have shillings 1 million. So we're saying the value of 1 million shillings today, this, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value, or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, You can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. compounding techniques. So we start with the compounding techniques number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount amount with, let's say, 100,000. No, will that give us? No, that is the only way. Okay, the other method is where we say, but this one is very long, where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue, but that will not apply in this case because we are only investing 1. So you can continue, you grow by that rate, So just stick to this. Just stick to this. Any question before we continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return, or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something, just write an example, an illustration, say